The story remains the same, very strong labor market.
I think it's going to start to weaken. And so this is why the Fed needs to act sooner rather than later.
If the Fed can navigate this very narrow path, I think that you can start to see equity markets move higher.
You got to give them credit for pivoting as quickly as they have, and they can pivot again if the data demand it.
It's just a pivotal moment for Fed policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here we go again from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative 1.5 on the S&P. TK, 5 weeks of losses. That sell-off extending into week 6.
The headline today is a sell-off extends, John, with the VIX up 3 big figures, 33.31. John, there's tons of international relations news. Mr. Putin obviously speaking in Moscow. All of it secondary to the market response that we see this morning. Where do I see it? That deepest market, dollar stronger.
That dollar strength is unreal. DXY the strongest since 2002. Pick your currency pair, TK. We've had another 1% move in dollar China.
You know, John, I know you came in late. I was here at 3 a.m. with Lisa. We were looking at the dollar and the FX charts as well. And I can't say enough, as you mentioned, 2002, how we have a strong dollar testing out to historic dollar strength back to the Plaza Accord.
Bramo just told me she had an extra hour in bed, so I'm not sure what you're talking about.
It didn't work.
It didn't work
Actually,
out, Bramo.
No, it didn't work.
In,
I tried to hide under my covers.
I think everybody did after last week. And Lisa, just remember, it was a 20 basis point move on the S&P. It was 0.2% lower on the week, but it felt absolutely brutal.
The intraday moves were dramatic, and I think this volatility is something that people are not used to, and I think part of it is because it's not stemming from Fed volatility. People can attribute it to the Fed, but it's not the Fed. This is the realization that they're tied between a rock and a hard place. They don't have control over a market that is increasingly concerned about recession, and it's increasingly tied to what's going on geopolitically, whether it's having to do with Ukraine or whether it's having to do with China lockdowns.
Looking ahead to CPI on Wednesday and hoping, Lisa, that we start to see, again, some more deceleration.
Yeah, but you've said this before. Does it matter if we just saw peak inflation? Does it really matter how far it decelerates? If we end the year at 4% inflation, are we going to feel good? Is the Fed going to say, okay, we're done? I don't think so.
I'm with Lisa, Tom. A mechanical peak in year-over-year inflation is not the story here. How much longer will this persist and how much tighter does the Fed need to be? That's the secret sauce to the future.
Yeah, it's the data coming in and what's the Fed going to do? When's the next Fed meeting? We just got over the last Fed meeting. I'm still recovering from the show. June 15th, John, and along the way we'll have inflation. And the inflation battle over the weekend, John, was extraordinary, where Mr. Silver over at J.P. Morgan looking more short-term at services sector inflation catching up with goods inflation. And John, you featured the hotsiest piece this morning where he flat out says it's over, it's done. He looks for quiescent inflation out a year.
And for the first time in the last couple of years, looking to downgrade inflation forecasts instead of upgrade them. Thinking of central bank decisions, Lisa, I'd say the ECB is in a spotlight in the next couple of weeks. June 9th.
Not in a good way. Do they follow the Bank of England with a dose of honesty that's not exactly well received, as we can see from the pound, or do they come out with something trying to be a little bit more comforting? How do they do that when it's really kind of gotten away from them, the narrative of inflation tied with slowing growth?
Let's whip through this price action this Monday morning. Good morning to you all. We are negative on the S&P once again by 1.5%. On the Nasdaq 100, you cannot get a break. We're down by 1.9%. Yields are higher on a 10-year by 6 basis points to 319. Get used to that. Looking at 320. And Lisa, the 5-year, up another couple of basis points than the highest since 2008.
You know, we've gotten so benumbed to these record highs or these highest since 2008. But every day to get a new post-crisis high, whether it's a post-pandemic crisis or post-mortgage debt crisis meltdown, getting that every day is sort of shocking to the system. We'll get a read on that. And really, there is not a lot of economic data today. We're all the countdown to the CPI Wednesday. But today we have an incredible lineup to give us a sense of, are we there yet? When do we get capitulation? What are the geopolitical macro risks that could potentially torpedo the economy? George Saravelos of Deutsche Bank with some really interesting calls on the euro. You can ask about the ECB meeting, John. Adewale Adeyemo, the U.S. Deputy Treasury Secretary. How much do they deal with some some of the sanctions and as well as the tariffs on China at a time of rising geopolitical tensions. And Matt Dizak of the Maryland Bank of America Private Bank, who has a really interesting call about how much losses have already been baked into some of those treasury yields. The whole, when do you come in and start buying this dip? At 8 a.m., we also get Atlanta Fed President Raphael Bostic joining, of course, our own Michael McKee here on Bloomberg Television, giving a sense of what's next for the Fed. I do think the narrative has moved away from what's in the Fed's control. A lot of this is just out of the Fed's control. It's the response mechanism. And 2 p.m., I know that Tom is looking to spend more money. I'm sure that his budget has already been so low that Meta, Facebook, is opening its first physical store, the Meta store in Burlingame, California. The reason why I'm putting this out is not because I actually want Tom to go out and spend more money. It's because Facebook, year to date, has absolutely had its face ripped off in Wall Street parlance. 40% decline. This idea of where does the growth come from in the growth names? The Nasdaq down more than 20%, John. How do they recoup faith in the idea of growth?
Did she get that CFA phrase, their face ripped off from one of her kids this weekend?
I think that's what I threatened,
The metaverse, Tom, where stocks are higher, Bitcoin's at 80K, and Facebook is not down by 50%.
Well done. It's a beautiful world.
Good times. Can't wait, Bramo. Thank you. Let's get to Eric Friedman, CIO at US Bank Asset Management. Eric joins us now. Eric, equities have been trashed. We've seen the same thing happen in the bond market. Is it time, Eric, to buy bonds?
Jonathan, we would incrementally be adding to duration here. I don't think this is a time you have to get hand over fist involved in the bond market. We still think there are opportunities in the commodity space, so specifically infrastructure would be our preference. But technically speaking, we're at 3.25 for the 10-year. That's a critical level. And 3.25 has not been a level we've been able to sustainably be below. So we'd be incrementally adding here, but I want to see if 3.25 holds before getting more aggressive.
When do you buy stocks?
I'd say, Tom, really our downside case would be 38.50, 3900, which would put us at 17 times a $225 figure, which I know the multiple is being discussed quite a bit, but we'd have to see this neutral rate conversation really slowing down. It's good to have more Fed participants talking about where they see the upper bound of Fed funds, but we're at 280, Tom. Yeah. And that's the expectation for the end of the year. If we get to 3.25, that's another down 5, 6, 7% from here. So want to hear more of that chatter settle down.
In the bean counting, Lisa, Ben Laidler over at eToro quantifies U.S. profits up 10%, EU profits up 30% plus as a backdrop to all this gloom right now.
Which raises a question about whether the dollar truly is and will continue to be the haven. Eric, do you really focus on dollar assets? Do you focus on the dollar itself as the haven, or do you think that that's been basically overplayed at this point?
Lisa, it seems like it's overplayed, but it's hard to get in the way of it right now. And if you look at the bias, what we're tacking back to from an economic standpoint, Japan doesn't have a great base case of growth. Europe doesn't have a base case of growth. So still think that the cleanest dirty shirt, if you will, still remains the U.S. So again, we're approaching some critical technical levels for dollar yen, for dollar euro as well, but we would not get in the way of owning the dollar here.
If we can't guess this horrific war, Eric, we can guess that at some point China will move away from lockdown. What will a China moving away from lockdown do to the stock market?
You know, Tom, I think that if you look at Neil Kashkari's piece from last week, that's a good insight into at least Fed mentality about lockdowns. And what I think that means for us is that there's this viewpoint that that's been a source of really higher prices and sustained higher prices. So if we start to see those lockdowns removed, we start to see ports free up, that could incrementally be a positive. Now, the other key variable is what does that mean for demand? And demand is the thing that we still think is there from an underlying trend perspective, but we also run the risk of a second repricing lower if we see demand destruction roll back. In other words, if we start to see China ease lockdowns, but we actually don't see follow through on demand, that would be concerning for us. So net in the here and now, we think it's a positive, but incrementally, if it means that we don't actually see that follow through on demand, that would be concerning for us. That would be the second repricing lower in risk assets.
Eric, just quickly, how important is Wednesday's CPI print?
I'd say, Jonathan, we have to see a migration lower. So, 8.5 back down to 8% doesn't feel great. But if we see a sticky level because of where hydrocarbons are or because of where rents are, that would be a negative. So again, we think that incrementally showing some trend downward in the rate of change is what we're looking for. But the real meat of inflation rollover has to happen in the next couple of months versus the next two readings.
Eric, you're one of the best. It's great to catch up with you, sir. As always, Eric Friedman there of US
Jonathan.
Bank Asset Management. CPI this Wednesday, TK, that is without doubt the next big stop for this market.
It is, and the PCE is what the pros are focused on because that's what the Fed is focused on as well. The core nominal thing, John, I have trouble with. You look at what a gallon of gas is doing, what diesel's doing. Who really cares about a core statistic right now? But I do take Eric Friedman's point that to lean on this one report coming out is probably off the mark. It's getting the data in, and that's part of this market. John, I got to focus on Nasdaq down 2%.
It's brutal, Tom. Down by 1.9%. At least 5 weeks of losses on the Nasdaq, 5 weeks of losses on the S&P. I think for 5 straight weeks, yields have been climbing as well on a 10-year. And for 5 straight weeks, we've had dollar strength too. It's been a story for the last, guess what? 5 weeks.
5 weeks is the longest streak of losses for the S&P going back to 2011, which raises the question, are we there yet? Have we seen true capitulation? And BTIG's Jonathan Krinsky actually came out and said, no, watch what they're doing, not what they're saying. You are not seeing those forced sales yet, which is sort of shocking given the level of declines and this feeling of a slow grind that we haven't felt really since the 2000-2002 kind of sell-off.
Chris Harvey of Wells Fargo would call that the cathartic puke. Is he suggesting we haven't seen that just yet?
The face rip-off.
Face rip-off.
Cathartic.
It's all happening today, Tom. It's all happening.
Oh, yeah.
We've had a couple weeks, haven't we?
John, Drawdown. Let's do an update because all of a sudden there's our first big number that we see, folks. This is futures drawdown. SPX -15, the Dow -12. John, the Nasdaq just under a -25%.
Let's call it what it is.
Wow.
It's a bear market. The Nasdaq 100 down another 2 percentage points. The S&P off by 1.6% with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro for our audience worldwide from a beautiful New York City, looking at an ugly equity market again.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia's President Vladimir Putin justified his faltering invasion of Ukraine as a battle comparable to the fight against Nazi Germany. Putin spoke at the annual Victory Day celebration in Red Square, marking the defeat of Germany in 1945. He said the conflict with Ukraine and the NATO members sending the country weapons was inevitable. The dollar's dominance continues versus all its major peers. A Bloomberg gauge of the greenback extended gains into a third day. China's lockdowns, accelerating inflation, and the worsening outlook for global growth have boosted demand for the dollar as a haven. And over in China, exports and imports struggled last month. Coronavirus outbreaks cut demand, undermined production, and disrupted logistics. Export growth fell to the lowest in almost 2 years. Imports were unchanged, but would have been weaker without those rising commodity prices. And in the Philippines, polls indicate the son of the late dictator Ferdinand Marcos is set to be elected president today. Ferdinand Bongbong Marcos Jr. has been helped by a barrage of online propaganda painting the tough martial law years under his father as a golden era. His main rival, Vice President Leni Robredo, says there's concern over malfunctioning voter counting machines. And it is ending as fast as it began for retail day traders. Amateur investors who jumped in when the lockdown began have now all given back their gains. That is according to an estimate by Morgan Stanley. Higher interest rates have led to a bear market in speculative stocks that surged when the stimulus started flowing in 2020. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I worry that the Federal Reserve has tried to be too nice to markets, be it the transitory inflation narrative that lasted way too long, be it what happened on Wednesday. You know, you cannot come on TV and speak about all the uncertainties and then rule out a certain policy response, 75 basis points,
What a call from Mohammed over the last 12 months. Mohammed Al-Arian there from New York City this morning. Good morning, live on TV and radio. We gap lower again on the S&P by 1.6%, on the Nasdaq 100 down by almost 2 full percentage points. Yields higher by 7 basis points. We're looking at 320 now on a 10-year. In the FX market, dollar strength all over the place. The dollar index the strongest, going all the way back to 2002. And if you are a big oil importer right now facing higher crude prices and a stronger dollar, you have got a problem. And India, Tom, has a little bit of a problem.
They do. This is not expect the unexpected. This has been, frankly, widely anticipated, John. This is a country with all sorts of unique challenges. And then there's the unexpected, John. And the unexpected is last month, the temperature averaged 104 degrees. I can't do the centigrade translation for you, John, but that is unimaginable even in Tucson, Arizona. They are in the midst of a drought, overlay Ukraine, even with Russia with supposedly a good crop. This is about beginning to deal with the food crisis in India. I'm going to suggest, John, less about hydrocarbons and much more about wheat.
A big crude importer as well, Tom. A lot of problems, as you say. The latest news from the Indian Central Bank said to be intervening in the FX market. Record weakness on the rupee, Tom. You can see why.
It's linear. I did a regression back to the financial crisis. And you know what, to be honest, it's on trend depreciation. But there is some convexity to it. There's an acceleration here, John. And critically, it's out to new record weakness. And again, it goes back to the export and import dynamics of drought and food.
Every currency pair you look at right now, Tom, just seeing some big moves. To see dollar CNY, another 0.9% move at 1 point, almost 1 full percentage point. This is big stuff.
It's big stuff, and it is the global litmus paper. I mean, we don't even talk about it. Loonie, Canadian dollar, well out over 129 week. Aussie, you looked at that, John. When do we see a 0.69? Turkish lira, moments away from 15 lira per euro. These are all small stories that aggregate to what Folkers Landau and, frankly, President Trump were talking about, which is the persistent strong dollar.
Very briefly, Tom, we did have a break of 70 on the Aussie overnight. 69 handle, very briefly.
Yeah, well, it's about time to have a Foster's lager.
Are you set to offend anyone else this morning?
No, I'm going to move forward and offend Maria Tadeo in Brussels and Amory Horton in Washington. We can offend both of them on an equal opportunity basis. Maria, a general question with the fanfare in Moscow. You're reporting on this moment for Mr. Putin.
Well, Tom, to me, what was very significant is not so much what he said. I mean, we're expecting it's the usual spiel. This is NATO, of course, being a danger to Russia. He talks about the great Soviet victory over Nazi Germany, this great moment that, by the way, Russians referred to as this great patriotic war. They really believe it's the Soviet factor that changed the outcome of the war. But to me, what was key is what he didn't say. When you look at that speech, he did not use the word Ukraine. He did not mention it flat out. It wasn't there. He repeated 8 times Donbass, but that was it. There was no reference to the capital of Ukraine. There was no reference to Mariupol. There was no reference to this full war. Remember, there had been some anticipation that perhaps Vladimir Putin could today use this as an opportunity to declare full war on Ukraine. That didn't happen. So to me, that was quite telling. And in some ways, it was softer than what many were expecting.
So Maria, jump forward in terms of what that actually means. In other words, do you think that this is a de-escalation, that it will be okay if Russia just gets the Donbass region and we'll move on?
Well, maybe that you could interpret that as that way. The Donbass will now be the focus point. He talks about the annexation of Donbass, some of the places in eastern Ukraine too. The issue here is that Ukrainians say that that is just not going to happen, that there won't be a peace deal if Russia takes over Donbass. Also, when you look at the Ukrainian perspective, they really believe that even if they hand over the Donbass, that is not going to put an end to this question, that Russia will just use that to regroup, rearm, and then go back at it in 2 years' time. The other thing that to me was very telling is Vladimir Putin said this conflict was almost unavoidable, it was inevitable. And Ukrainians also believe that in many ways, that this was just going to happen, that Russia under Vladimir Putin and Ukraine moving to the West, they simply cannot coexist. And of course, that's not good. If you look at perhaps a potential peace deal, which is completely over now, I mean, the talks are not even happening. So to me, I wouldn't take this as a sign of de-escalation just for the time being.
And Maria, in the meantime, from the United States, Joe Biden the First Lady, went to Ukraine overnight, actually, in an unannounced visit, obviously. What's the significance of that? I mean, if you look forward to foreign policy in the U.S. and what they're hoping for in the nation.
She shared a lot of correspondences, written correspondences with Volodymyr Zelensky, the president's wife, Ukraine's first lady, and she made this unannounced visit. And she said she wanted to spend Mother's Day with Ukrainian mothers and displaced children, and also meet the first lady of Ukraine face to face. We have not seen Mrs. Zelensky since the war began on February 24th. So really, this was very symbolic. And we should note she's getting a lot of claps and pats on the back from both sides of the aisle here in Washington. A lot of Republicans really liked this show of strength, that what she did as she was in Eastern Europe, deciding to go to Western Ukraine to meet with Ukrainians face to face.
Maria, what is next for Brussels?
Well, Tom, there's G7 meetings that happened this week. Then there's, of course, the big NATO summit happening at the end of this week, and a lot of diplomacy. But I think the issue now for Brussels is that we see that the internal politics are becoming a problem. We see it with Viktor Orban on Hungary. To this date, we still don't have this oil embargo agreed. You see it in the internal dynamics of Germany. Olaf Scholz, his approval rating keeps plummeting. And today we have Emmanuel Macron, but in many ways, he continues to be criticized for being on the phone with Vladimir Putin. So it's the internal politics that, to me, I really struggled to see what is the European position on many of these issues.
Dead on.
Maria, got to leave it there. Maria Tadeo there alongside Bloomberg's Anne-Marie Hordern. Tomorrow, reportedly, we will hear from the president on inflation, Tom. An address from the president of the United States 24 hours out from a CPI print. So Tuesday, the president, Wednesday, inflation.
Yeah, he's going to manage that message forward, and we'll have to see what it does with oil, 113 on Brent down to 110 as well. John, Maria mentions the German elections. I know it's beneath the radar, but it is a huge, huge deal. This is up by Denmark, and Mr. Scholz was absolutely crushed. There's no other way to put it. Another important election coming up this Sunday, and I think Maria's dead on. It's about microdata in Europe right now to that ECB meeting.
She's always dead on. And just quickly, Tom, Victoria Bitter, that's the most popular Aussie beer, just so you know.
Oh, thank you.
Okay.
Victoria Bitter.
They will tell you they don't drink Fosters.
I know, that's, well,
I know you know, and that's why I know you know you were insulting
in
people.
In Perth, they drink Victoria Bitter.
I'm going to stop insulting people.
Live from New York City this morning. Good morning to you all on TV and radio. Once again, we head south. On the S&P, down by 1.7%. On the Nasdaq, we're down by 2 full percentage points. 5 weeks of losses on the S&P, the longest weekly losing streak going all the way back to 2011. 5 weeks of gains on a 10-year yield as well. Let's check out the bond market. Looking at 2s, 5s and 10s. Your 10-year, 318.66. Got to go back to 2018 when we saw something north of 323, almost close to 324. Once you take that out, you're going all the way back to 2011. Very, very close to those kind of levels. Right now, yields higher on a 10-year by 6 basis points. On a 5-year, the highest since 2008, up about a basis point or so on the session to very close to 3.1%. That's the bond market as yields inch higher. The dollar is so much stronger. Your dollar index, the strongest going back to 2002. Dollar yen levels we haven't seen in 20 years with dollar yen at 131. And TK, we talked about it, a brief break of 70 cents on Aussie US. That was the story earlier on. A 1 percentage point move today.
Well, we've got to do quotes here more often as we can, John. I mean, to see Australian dollar move there is important. And, of course, Australia, renminbi is another relationship. John, we are scrupulous about our corrections. Listening in Perth this Monday evening in Perth, thank you so much for listening. And I got my beers all messed up. I flunked it. Aussie 108. It's Swan Lager. And if you're really something, the Emu export, John, has an alcohol content of about 14%.
There we go.
It's like a beer like vodka or something like that. But Swan Lager, Emu expert, good morning, Perth, as they say.
I told you that the Foster's joke would be a problem.
Yeah, it is. I went down in
problem.
flames. I'm allowed to go down in flames every
Do you want to do your Aussie accent again?
No.
You're done?
We don't want to do it. It's more Queensland because of Crocodile Dundee, but no.
Is that right? Do you want to offend them too?
No, I've offended everyone. I'm group effort. But Aussie dollar is important. We're making jokes about this, folks. But what global Wall Street's looking at right now, John, as you know, is to triangulate. And what we're not saying, John, with this equity carnage is the triangulation is off the U.S. 10-year yield.
The Aussie story, Tom, typically would have a high beta to say to Chinese growth, to global growth, to commodities and all of that.
Yeah.
The Chinese data was pretty weak. And the weakness we're seeing in the Chinese currency is something we haven't seen, did not see at all last year. We saw the weakness in the economy, didn't see it translate through the FX channel. We are now in a much bigger way.
And tape deterioration since we started surveillance this morning. Nasdaq at 102.12% for those keeping score at home. VIX out three big figures, 33.61. On the American economy, as we pick up the pieces of May, Lindsay Piegza joins now, chief economist, Stifel. Lindsay, thrilled to have you with us today. I want to talk to you about your thinking over the weekend on the call the recession parlor game. I don't even want to take the time about who's where in that. How do you sit there at a desk and call a recession?
Well, at this point, we are looking for negative growth, but we haven't yet been convinced that we're going to see outright recession. The chairman, as we saw in the latest commentary, did back off from those larger possibilities of hikes at 75 basis points. Now, he did still say that additional 50 basis point increases are on the table, so they're still in a hawkish position, but a relatively less hawkish position as he continued to talk about the optimism for navigating a soft landing. So I do think that the committee is well aware of the weakness already seeping into the data, and that gives me some sort of optimism that the Fed will begin to back off as it becomes more clear that they've tightened us now into a position of weakness.
Lindsay, over the weekend, we've got analysis on inflation. And to be fair to J.P. Morgan and Goldman Sachs, one is a more long-term view of disinflation, Hotsius, and Silver, over working with Ferroli at J.P. Morgan, is looking more short-term at what has not occurred, which is inflation has stayed elevated. Which time frame is of most value to you to analyze price change?
Oh, it has to be short term right now because that's what the Fed is looking at. And we do expect this week's number to give us somewhat reprieve. But remember, it takes time, months, for supply chain disruptions to filter into the figures. So the improvement that we expect to see in the April release very likely reflects the improvements that we saw at the start of the year before Russia invaded Ukraine, before the second and third round of lockdowns that we've seen since overseas. So while we will see more positive improvement in the numbers, I'm hesitant to say that that means we've already reached peak levels. Again, with these lockdowns coming into play, with the Ukrainian conflict now moving into its third month, we could see prices peak back up as we move into the third quarter, really complicating the picture for the Fed. But again, the near term is what monetary policy and the markets are going to be focused on.
Lindsay, that was what Neil Kashkari of the Minneapolis Fed was addressing in a speech that he gave in an essay he wrote on Friday, how basically the supply chain disruptions and Chinese shutdowns due to COVID may have a greater effect on the idea of recession in the U.S. than anything that they can do, and that they actually may be forced to raise rates faster in the face of prolonged shutdowns. What do you make of that? I mean, is this basically the mainstream view that the Fed has lost the plot and this really has to do with geopolitical events?
Well, it's a difficult scenario because typically the Fed is raising the cost of capital, raising rates when the economy is overheating. And the intention is to slow consumption, slow investment, and by extension, then we see softer overall domestic activity and more benign inflation. This time around, however, we're starting from a baseline of far from an overheating economy. The economy is just moderate at best, arguably poised to slow further as we're still struggling to grow organic legs in the aftermath of the crisis. Now, to complicate the equation further for the Fed, the vast majority of price pressures, as you just mentioned, are stemming from supply chain constraints. So this renders traditional monetary policy metrics less effective in fighting inflation. So as the Fed continues to raise rates, yes, that will slow the demand side of the equation, but in fact, it could lead us to the scenario where we're still dealing with elevated costs due to international conflict, international policy, but now we have to contend with the effects of a softer or slower economy.
So, Lindsay, what's the playbook if, as you predict, we don't necessarily get a peak in inflation just yet, that we see actually a higher levels coming up in the upcoming weeks and months? What's the consequence on the economy?
Well, the consequence for the economy is the Fed remains aggressive in its pathway. And rather than backing off to 25 basis points in the second half, which we do expect, the Fed continues along at 50 basis points a clip or even accelerates to 75 basis points. And again, that leads us to that stagflation scenario that I just outlined, where we're still dealing with higher costs, elevated inflation, but now the Fed has tightened us into recessionary conditions.
Lindsay, do you have a clue how corporate America, and not only the I within the GDP equation, but just as a general statement, how corporate America will adapt and adjust to these historic times?
Well, I think businesses are struggling amid the weight of rising inflation. Remember, it's not just the consumers feeling these price increases, it's also businesses. Parts, materials costs are rising, and businesses right now do have a lot of wiggle room in the market to pass those higher costs on to consumers without the risk of losing market share for now. But as we see the household balance sheet continue under pressure, energy prices rising, agricultural prices rising, that is taking a larger chunk out of consumers' ability to spend then outside of discretionary items on non-discretionary goods. That's going to complicate the process for businesses being able to pass on these costs to the end consumer.
Lindsay, when will we actually see this? Because a lot of people keep pointing to the strength in the consumer as the reason for no recession this year. When will we see something different?
I think we're already seeing something different. When you look at the consumer adjusting for inflation, we see real income is down deep into negative territory, off double digits on an annual basis, and real consumption is already trending back down below 2%. And as we continue to see the household balance sheet, real income eroded, that's going to continue to exacerbate this downward trend in consumer activity.
Lindsay, thank you. As always, Lindsay Piegser there of Stifel. Thank you very much. If you're just tuning in, we're breaking down again on the S&P by 1.9%. On the Nasdaq 100 now, down by 2.3%. Equities breaking down, yields breaking out by 5 or 6 basis points on a 10-year to just short of 320. We had a little look at that level a little bit earlier on. In the FX market, seeing nothing but dollar strength against everything in G10. The dollar index the strongest, going all the way back to 2002. Euro dollar just about holding on to 105. But the Aussie with a break of 70 cents a little bit earlier, Tom. That's where the underperformance is in G10 this morning.
Well, it's time for an emu export. There's no question about that here, John. I mean, Australia's moving. The others are moving. I guess, John, the one thing I would watch, frankly, and it's, I know it affects you, is sterling. We had a 122 handle when I walked in the door. We've come back a little bit. Sterling 123.18. But, as we triangulate the Bloomberg screen, folks, it's simple. This early in the morning, 6:39, maybe, John, we haven't tightened up to where we'll be at 8 a.m. or 9 a.m. this morning.
122.61, the low of the session on cable. In many ways, the situation in the UK, Tom, I think captures the fears of the moment. We've talked about that repeatedly over the last week, this idea that you end up in a more prolonged state of higher inflation together with aggressively decelerating growth and potentially a contraction. Well, Seth Carpenter over at Morgan Stanley just summed it all up for everybody. We live in the most chaotic, hard-to-predict macro environment in decades. He goes on to say, avoiding a recession is our base case. That's the kind of thing economists say. But acknowledge this. This is what markets do. They have to shift around a range of probabilities, and those probabilities are changing all the time. Here's the quote from Morgan Stanley. Markets will have to confront the rising probability of one regardless. Even if it's not the base case, the probabilities are shifting, Tom, and the market has to shift too. Well,
we're in the middle of two once-in-a-lifetime moments here. The pandemic and, of course, some, not grim, but some more difficult news maybe on COVID in the last 3-4 days, John, from the really good news of the last number of weeks. And then completely separate from that, the war, which, Maria today over in Brussels is dissecting for us. Everybody's adapted to it, and I'm sorry, I'm using the Bloomberg and foreign exchange as the litmus paper of the moment.
Bramo hoping for some better news this Wednesday.
But how much is it really going to matter? How much is this really a geopolitical story that the Fed has lost control over? And frankly, that's the reason why you're seeing such volatility.
We'll keep coming back to it. The S&P down 2%. The Nasdaq 100 down by 2.4 and yields are higher by, let's call it 6 basis points to 318 on a 10-year. From New York City this morning, good morning to you all. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Vladimir Putin evoked Russia's fight against Nazi Germany as he defended his faltering invasion of Ukraine at the annual Victory Day celebration. He said the Russian military is defending, quote, what our fathers, grandfathers and great-grandfathers fought for. An advisor to Ukraine's President Zelensky responded on Twitter saying that the Russian army is dying, not defending their country, but trying to occupy another. The U.S. government had a record tax haul this spring, and some of the credit goes to the surge in individual stock trading by Americans. According to the Treasury Department data, tax collections since the start of the fiscal year in October are running at a record high, up some 43% over the same period in 2019. That surprised Wall Street and is shrinking the budget deficit. And in Hong Kong, incoming leader John Lee has promised to bolster national security and accelerate integration with mainland China. The former security minister is preparing to take power after a near-unanimous election by a Beijing-controlled committee. Lee helped outgoing Chief Executive Carrie Lam crack down on democracy protests 3 years ago. And Sri Lanka has imposed a nationwide curfew following clashes between protesters and government supporters. Demonstrators have demanded that the premier and his brother, the country's president, resign in the midst of Sri Lanka's worst economic crisis since independence. Prices of everything from gasoline to medicine are soaring. Sri Lanka has suspended payments on foreign debt. 20 U.S. internet providers will offer high-speed connections at essentially no cost to millions of low-income households. It's part of a program funded by the infrastructure law passed last year. AT&T, Comcast and Verizon are amongst companies taking part. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
There are no red lines for the regime in Moscow, so we're preparing for everything. They said they were not going to attack us, and they did. The question is, are we all prepared, the civilized world, to do everything possible to defend our democracy and freedom? And Ukraine certainly is not only ready, but shows for the past 74 days that we bravely defend those values.
Oksana Marakova there, the Ukraine ambassador to the United States on CBS. From New York City this morning, good morning. Breaking down again by more than 2% on the S&P. We're down on the Nasdaq 100 by 2.5%. And we keep going lower. Yields are higher by 5 basis points, 317.86 on a 10-year. You've got to go back to 2018 levels to see this yield higher on a 10-year at least. In the FX market, Tom, euro dollar doing okay, negative 0.1%, but dollar strength certainly the story here across the board.
We'll continue to follow this, and as John says, folks, I really want to make clear there is a deterioration in the last 2 hours here at 6:48 Wall Street time. We've taken great pride in our coverage in international relations of this horrific war in Ukraine. Just as one note, General Kimmett the other day was mesmerizing on the military operation. Now from the College of the Holy Cross, Cynthia Hooper joins, Director of Russian and European Studies, with some terrific work out of the Harvard-Princeton Combine on Russia and on over the years. Cynthia, this from the great leader. Today, you're defending what our fathers, grandfathers, and great-grandfathers fought for. The bottom line is there is a conflation here rhetorically of the Nazis and a special military operation. What is next in this resurrection of the Nazis of World War II?
Well, watching Russia's Victory Day celebrations earlier this morning, as I'm in Germany right now, I was just struck by Putin's speech to the troops because of some astonishing things that he said that maybe American audiences wouldn't pick up on immediately, but certainly are very clear to Russian domestic audiences and to Europeans. Above all, Putin actually drew an implicit comparison between the Nazi regime under the Third Reich and their ideology of racial superiority, and the United States after 1991 with what Putin claimed was its ideology of political and economic exceptionality. And Putin actually said that the United States has been humiliating the rest of the world and even its own European allies who have to lap up this rhetoric of superiority. And Putin also went on to assure his domestic audience that Russia in 1945 and again today is acting only in self-defense. He said that actually, Russia had approached the United States, wanted to talk about global security, been rejected, and that Russian intelligence had discovered that the United States was planning an invasion. So Russia had no choice but to invade.
The heritage of Holy Cross, besides giving us Dr. Fauci, is to put religion within the calculus of our international relations. We've talked very little, Dr. Hooper, about this idea of the Greek Orthodox Church, the Eastern Church, if you will, the Church of Kiev and the Church of Moscow. How does religion fold into the framework that Mr. Putin has in his mind?
Well, if you talk to the Ukrainian church, they would stress that there's actually a significant schism between Ukrainian and Russian Orthodoxy. But again, Putin in his speech today listed a whole number of cities that he said had courageously resisted the Nazis. And these cities are located in what today are Russia, Ukraine, and Belarus. And Putin referred to a spiritual unity that binds these places together, which he implied is much stronger than any kinds of contemporary ideas of national sovereignty.
In the meantime, we see some sort of spiritual unity, at least when it comes to trade between Russia and China. How does that nexus fit into what you're talking about?
Well, Putin is emphasizing actually that Russia is right now standing for together with the majority of the world's population in resisting United States domination. And so he talks a lot about China, but also India and Africa not supporting sanctions against Russia. He stresses that that is where the majority of the world's population lives. And he also emphasizes, just as he did in 2014, when Russia first occupied the Crimea, that if Europe is going to cut Russia off with sanctions, Russia doesn't need to worry about that. Russia can make new alliances with developing nations, the BRIC countries, and particularly look eastward towards China.
Do you have a sense of what the popular opinion is at a time when there is a growing sense that people are trying to get news through VPNs and not necessarily through the traditional mainstream of the Kremlin-controlled media in Russia?
Yeah, great question. It's very hard to gauge popular support for Putin right now. The current polls do show his popularity rising. The most recent number was 81.5%, but there's reason to be skeptical about such figures. And also, Western analytics say that fully 1/3 of Russia's internet users have downloaded at least one VPN, which allows them to, act as if they're logging in from another country and thus evade Russian government restrictions on internet usage. Also, according to whatever statistics you look at, somewhere between 300,000 to 1 million Russians have left the country because they don't want to be accused of collaborating with the Putin regime. And these are college-educated professionals. At the same time, I think that many Russians who are left in the country, all the ones that I know that remain in the country, which is a decreasing number, they're kind of doing what a lot of Germans did during the days of the Hitler regime before World War II actually started. They're retreating into the private sphere. One thing that you didn't see on Russian TV during these Victory Day celebrations were a lot of pictures of huge crowds outside Red Square. And all the people I know have actually taken the last 2 weekends or long weekends in Russia, the May holidays, as a chance to go to their dachas. They're hunkering down. They're trying to plant on small land plots any kind of vegetables they can, trying to anticipate rising food prices, a winter that could be hard if this war goes on and Russia continues to be the target of sanctions. And they're trying to sort of figure out how they and their family can hunker down and survive and try to remove themselves from the regime while perhaps not openly resisting it.
Cynthia, valuable insight and perspective this morning. Thank you. Cynthia Hooper there of the College of the Holy Cross. If you're just tuning in, we are breaking down on the S&P, down about 2%, down 2.5 on the Nasdaq 100. The FX market is something that keeps drawing our attention back to it. We're seeing a move on dollar lira back through 15. And if you're looking at the best and worst performing currencies in emerging markets, the Turkish lira, the second worst performing currency of the year so far in emerging markets, negative about 11%. Do you know what the second best performing currency this year is in EM? After the Brazilian currency, Tom?
The Russian?
The Russian ruble.
Yeah,
Russian ruble stronger by a little more than 8%.
Yeah, 69.34 off that 84 level. Sri Lanka Prime Minister Rajapaksa resigns. Of note as well here. John, I love what Doug Cass says this morning. He says, how about a global margin call? To me, that's really interesting, John. What are the trades that are out there right now exposed?
Blowing up, perhaps, TK. The Nasdaq 100 down by 2.5%. The S&P negative 2 percentage points. This is Bloomberg.
The story remains the same, very strong labor market.
I think it's going to start to weaken. And so this is why the Fed needs to act sooner rather than later.
If the Fed can navigate this very narrow path, I think that you can start to see equity markets move higher.
You got to give them credit for pivoting as quickly as they have, and they can pivot again if the data demand it.
It's just a pivotal moment for Fed policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
5 straight weeks of losses in the equity market. Hello, week 6 from New York City this morning. Good morning for our audience worldwide live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures TK down another 1.9%.
Well, that's the way they're moving. The bid has not come in yet. What we can say across 3 hours here of the pre-show preparation and starting surveillance this morning, John, it's a situation that deteriorates. We're going to get out to a 34 VIX in a moment. We're looking for a bid, and John, just as one indication out there, Bitcoin under 33,000 joins the party.
Big moves there, big moves in the equity market and in foreign exchange as well, Tom. The dollar index, the strongest since 2002. This is big stuff.
We are very dollar-centric here, folks, and by that I mean foreign exchange-centric, with Turkish lira blowing through 15 to 15.02. John, the immovable force, as we talk to Michael Purvis in a moment, is the 10-year yield, 3.18%. Didn't we get through 3%, a cup of coffee ago?
320 now, Tom, overnight. In this session, big move on a 10-year, the 5-year, the highest since 2008. Bramo, we're pushing ahead to the big one on the schedule this week. It's CPI this Wednesday.
And how much we get that mechanical peak in inflation. And then looking forward, is that going to be something that we see continuing to decelerate, this idea that perhaps the Fed will get a reprieve from that? We're talking about the idea of risk not stemming from the Fed. It is stemming from supply chains out of China. It is stemming from oil prices that are surging, having to do with what's going on in Ukraine. And that, I think, is very hard for the markets to deal with, which is the reason that we're getting this tightening kind of ramification of volatility.
The line from Morgan Stanley, Lisa, I know this resonates with you too. Avoiding a recession is our base case, but markets will have to confront the rising probability of one regardless.
And how do you do that after a market has been benumbed by a Federal Reserve for decades, basically saying, we've got your back, suddenly not having their back, and all of these traders have to readjust to suddenly whipsaw action that does not have to do with what, a number of people say out of Washington, D.C.
Well, TK, the Fed put has been well and truly retired, hasn't it, given what Lisa's just laid out there for us?
We're going to talk to Michael Purvis about this, I guess it's a new regime, John. And to me, there's a repricing going on. You put it in historical context. Is it a bear market? Yes, certainly. As you mentioned, John, on Friday, many stocks just absolutely hammered. But you look at the indices and you say, well, where is the immediate catharsis? Have we seen catharsis yet, John? I don't think so.
Can we make the case that the worst of this is done? Lisa, I'd look to credit.
Well, yeah,
what's been interesting about credit is, yes, there's been damage done there, but spreads haven't blown out in a massive way like we might have seen maybe a couple of years ago. And that's intriguing from my perspective and from others too.
It's something I focus on every morning when I come in. I look at spreads on both investment grade and high yields in the U.S. to gauge exactly that. Do we start to price in credit risk? How do we get credit risk when you get well-capitalized companies that don't have near-term maturities? The next maturity wall isn't until 2025. So at that point, is credit even reflective of real risk? If companies don't have to borrow money and borrowing costs rise, does it matter?
That's the question a lot of people in fixed income are asking right now. We're going to return to that a little bit later. Futures right now on the S&P and on the Nasdaq into negative territory by 2.3% on the Nasdaq 100. On the S&P down by 1.8. Yields are higher on a 10-year, 318. In this session today, we had a little look at 320. Yields are higher by 5 basis points. In foreign exchange, the dollar the strongest, going all the way back to 2002. Lisa, euro dollar negative just 1/10 of 1% at 105.
So many questions this morning, including, are we there yet? Have we seen catharsis? When do we get the full washout? We will be talking about that with an incredible roster of surveillance guests. Deutsche Bank's George Saravellos joining us, talking about the euro, a possible strength there, which is interesting given the fact that it has been a one-way trade in dollar and the euro has absolutely broken down. U.S. Deputy Secretary of the Treasury is going to be joining us, Adewale Adeyemo. I am very interested to hear about what the U.S.'s next steps are in terms of additional sanctions towards Russia, but also with respect to China, given the legacy tariffs there. And Matt Dizak of the Merrill Lynch and Bank of America Private Bank talking about how much is already priced in with respect to Treasury yields. Okay, let's say that that's the case, but is there a non-linear move from 3.5% or 3.25% on the 10-year to 4%? At 8 a.m., we get Atlanta Fed President Raphael Bostic joining us on Bloomberg Television with our own Michael McKee, talking about possibly some of the guidance. And frankly, I want to know about what they think about the market's reaction to Fed Chair Powell's press conference last week. And at 2 p.m., Meta, Facebook, is opening its first physical store, the Meta Store, in Burlingame, California. You can go and live in a universe that's far more certain and less volatile than the one that we currently live in. The reason why I'm actually interested is not exactly that. It's because the shares are down nearly 40%. Nasdaq shares down more than 20% year to date. Where does the growth come from, John, for these growth names, given how much has already been priced in and given what we're seeing in China and, frankly, what a lot of people are saying is going to be a global growth slowdown?
And the problem is, and Lisa, thank you, is that, Tom, some of these names are actually still generating decent growth, and yet they're being absolutely pummeled in the stock market.
Well, this is important. And I think there's a lot of growth out there, and you wonder, what do you do? And we're not going to give investment advice here, John. But to your point again on Friday, there seem to be two markets, those of profit, surviving, holding on, and a lot of others just absolutely pounded. John, before we get to our wonderful guest,
sure.
Bloomberg Dollar Index since February 24th, the invasion of Iraq, up 6.7%. The call of the year so far is David Folkert's Landau.
Michael Purvis is going to join us now. Tom, founder and CEO of Tallback & Capital Advisors. Michael, can you make the case for the end of multiple re-rating in this equity market?
I think we're, by my math, John, I think, like we've given up about 3.5 PE points just year to date off those lifetime highs back, at the end of last year. By my math, if we're going to sort of call it a 3 to 4%, maybe 3 to 5% 10-year yield, by my math, we get to another 1 to possibly 2 PE points, and at that point, I think we're really done there. I think, my bigger question though is that the cross-asset volatility conditions right now are extraordinarily robust and dynamic. And I think there's you guys were talking about, these shocks from supply chains and some shocks from oil, which the Fed has limited ability to address. And I think one of the things that's going to help is only going to reinforce this very high rate volatility. It's not just rates, it's rate volatility. And if the cross volatility surface is that high, I just wonder, if there's so much dust kicked up in the air, and there's so much uncertainty about what the risk-free rate's going to be over the next period of years, then I think it's going to make dip buying, maybe, there's always traders who will come in for quick plays,
right.
But for larger out, more strategic commitments to the market, I think dip buying is going to be very challenged, certainly in the near term.
As many of you know, there are different Michael Purvises. Right now, we're going to go to the Matthew Purvis, if we can. And the Matthew Purvis has just pointed out cross-asset relationships or correlations. Michael, I adore your paragraph going more narrow on cross-stock correlation. It's not there, isn't it?
Right. It's been really, really low. And I think part of that is just simply comes down to the fact that, you look, if you're a long energy stocks, if you're a long materials or steel stocks this year, you were actually doing pretty well and maybe well up. And of course, if you were long some of the big tech or growthier names, you weren't doing so well there. And there was a real sort of, it wasn't risk off the way you had, we haven't, most of this sell-off this year, we have not had that 2010 or 2011 sort of binary, we're risk on today and everything's up, or risk off and everything's down. It was a much more nuanced. Now, I will say certainly these cross-stock correlations have been increasing last week and they're probably going to be certainly increasing today if the tape holds as it's looking at right now.
Michael, awesome to hear from you, buddy. As always, Michael Purvis there of Tallback, and just a flavour of one view on this equity market at the moment. Take a look at the bond market, not just on treasuries with yields high, but also over in Europe. Talked about this over the last week or so. This Italian 10-year Bund spread, north of 200 basis points now, going into this ECB meeting next month. And this takes some getting used to. Not Italy with a 10-year at 320, but Germany with a 10-year at 118. When last summer, Lisa, that yield on that 10-year was negative 50 basis points. And here we are, positive 118.
We've seen a complete retracement of the negative yielding universe. And we used to talk about what would happen if that happened or if it would never happen. And suddenly we've had a complete about face in terms of valuations in the debt market. We haven't seen the mass blow-ups. This is why we keep saying, where is the capitulation? Because we have seen a lot of pain, but it doesn't seem like forced selling types of pain that really raises questions about financial functioning.
Think about where all the weight of the international investor capital allocation has been over the last 10, 15 years. We've been talking about bonds, we've been talking about tech stocks. I've heard a lot of people talking about the tech story unraveling, the Nasdaq story unraveling. Tom, the bond market story is unraveling. You've got the ECB pulling back, the Fed pulling back, and we're seeing levels we haven't seen in a long time.
This is really important, John, and I'm clearly in the camp that fixed income leads equities. You learn that by losing money. John, sometime ask me about the time I lost a bunch of money on Amazon. Good morning, Lehman Brothers, and Holly Guthrie, the great Holly Guthrie, who were way out front on the collapse of Amazon off their bond paper. Bonds leave, John, and at your peril in the equity market, do you ignore fixed income analysis like Bloomberg, the real yield, which you can see 1 p.m.
Thanks for that, TK. I think something's changed, though, and we need to keep coming back to it this morning. Typically, when we talked about growth risk before, it was the curve was flatter, yields were lower. Something else is happening
Different
here.
regime, yeah.
It's a different regime, Tom. The framework that worked in the last 10 years might work in the future. I've got no idea. This is not a call. I'm just saying it's not working now.
People are worried about inflation.
Yields keep climbing, Lisa, and it reflects some of that. 318 on a 10-year from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia's President Vladimir Putin justified his faltering invasion of Ukraine as a battle comparable to the fight against Nazi Germany. Putin spoke at the annual Victory Day celebration in Red Square, marking the defeat of Germany in 1945. He said the conflict with Ukraine and the NATO members sending the country weapons was inevitable. An advisor to Ukraine's President Zelensky responded on Twitter saying that the Russian army is dying not defending their country, but trying to occupy another. And the dollar's dominance continues versus all of its major peers. A Bloomberg gauge of the greenback extended gains into a third day. China's lockdowns, accelerating inflation, and the worsening outlook for global growth has boosted demand for the dollar as a haven. And in the Philippines, polls indicate the son of the late dictator Ferdinand Marcos is set to be elected president today. Ferdinand Bongbong Marcos Jr. has been helped by a barrage of online propaganda painting the tough martial law years under his father as a golden era. His main rival, Vice President Lenny Robledo, says there's concern over malfunctioning voter counting machines. And in Sri Lanka, Prime Minister Mahinda Rajapaksa has resigned in the wake of protests over the plunging economy. Demonstrators have been demanding that he and his brother, the country's president, quit. The prices of everything from gasoline to medicine have been soaring. Sri Lanka is near bankruptcy and has suspended payments on its foreign debt. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
declaration of victory would not make peace in Ukraine, because the Ukrainian people will never surrender. The fighting will continue, and that's really the risk. That's a prolonged, simmering conflict. That's why we should do our utmost to bring a quick end to this conflict.
Anders Fogh Rasmussen there, the former NATO Secretary General from New York City this morning. Good morning. Session lows on the S&P and on the Nasdaq too. We are negative across the board here on the Nasdaq 100 by 2.45%. On the S&P down, let's call it 2 full percentage points. The yield curve's really interesting. We're talking about a growth scare, higher inflation, a Federal Reserve that's got to do some more. Yet the front end, we're seeing yields lower by 5 basis points on the 2-year to 268. And on the 10-year, Tom, we're seeing yields higher by 4 basis points to 317.
We'll do more data checks for you here today. John, I really don't even know where to go now other than to say the 10-year yield of 3.17, as we mentioned German yields earlier, it's just simple, a repricing.
Back to 2018, Tom.
Yeah.
The highest since. And once you take out 323, 324, we're talking about the highest since 2011.
VIX through 34 is critical in the last 15 minutes, 34.14. Maria Tadeo in Brussels. We spoke with her of the festivities in Moscow for Mr. Putin. Anne-Marie Horton in Washington. Considering a gallon of gas, Anne-Marie, within 2 cents of the March 10 peak. It's a redux for President Biden. What's different this time with record high gas prices versus March 10th?
Well, first, we do have the G7 coming out and saying that they're going to move to ban Russian oil. Obviously, waiting for the European Union to react to that and try to get their ducks in the row, because they obviously have some internal politics at play. That is going to play into the geopolitical risk premium on the global market. But really, if you want to know what's going on in the oil market right now, look no further than Javier Blas's latest opinion piece. He talks about refining capacity. And what you have is about 1.3, 1.5 million barrels of refining capacity wiped off the market because of self-sanctioning. Before the pandemic, you had refineries starting to wind down, older refineries. Basically, the margin from WTI to either jet fuel, gasoline, diesel for trucks, how we get groceries to our table. All of this is expensive. And the margin now, the Saudi oil minister talking about it this morning from Riyadh.
We're all
talking about refinery
We're all
capacity.
becoming amateur Javier Blas's here. Like distillate is my new word, Maria Tadeo. And diesel prices in America, in Europe, are even worse than what we're seeing in regular retail gas. Fold in this hydrocarbon analysis of Javier Blas with the stunning defeat of Mr. Scholz in the election over the weekend.
It's Blas, by the way. That's usually how you say it in Spanish. But if you look at what happened in that election yesterday,
that was a surveillance slapdown.
I had to say it. There's so many times I can hear it wrong. But if you look at that election yesterday, Tom, the issue really is for Olaf Scholz, he's caught in the middle. He says, we want to help Ukraine, but we don't want to escalate. We want to help financially, but we don't want to help with weapons. He talks about, of course, going after Russia and Russian oligarchs, but of course he's still buying gas. And it's almost this very tepid in-between response that essentially doesn't yield anything. Many will criticize him for being too soft. Others would criticize him for being too cautious. He really hasn't, he's not found his line. That's the problem for Olaf Scholz. He's caught in between too many different issues here. And of course, the legacy from Angela Merkel that continues to weigh in on him too. Remember, he was the finance minister at the time. So for him, I would argue he's a chancellor who's still trying to find the right tone, but of course is clearly struggling.
And Maria, this confusion is really felt at the conclusion from the leaders yesterday of G7 nations basically coming out and committing to banning imports of oil from Russia. So is there any clarity in that proclamation?
Yeah, and it was a statement that was completely emptied because the Europeans are still working on this oil embargo for themselves. This was really a statement that sounded great. It was a counter-narrative to Victory Day, but the substance, well, was still not there. And when you look at the Europeans, you can see that, as always, in the internal politics that makes this very difficult. You have countries, today like Hungary, the Czech Republic, Slovakia, that continue to push for exemptions. I hear from a European official that they believe come tomorrow there will be a deal, but this big statement by the G7, frankly, was it lacked the substance, and the fact that the Europeans did not have a deal really took away the shine from it.
And Marie, meanwhile, we do get comments from the president tomorrow ahead of the CPI print on Wednesday. How is he going to try to get ahead of what is expected to be another robust print, to put it mildly, even if it is a deceleration?
Well, he's also probably likely going to speak about it today, because he's going to talk about essentially a lot of eligible individuals in America getting free high-speed internet access. That'll be this afternoon in the Rose Garden. Tomorrow, which I would question, this is another curious timing on behalf of the administration. CPI is due on Wednesday, and I guess the president wants to get ahead of it. This is what we have from the White House official. He'll detail his plan to fight inflation and lower costs for working families, and contrast his approach with congressional Republicans' ultra-MAGA plan to raise tax on 75 million American families and threaten to sunset programs like Social Security, Medicare, and Medicaid. That is all we know about this preview to inflation, but clearly the administration, I guess, wants to get ahead of the data. I mean, it's curious that he just wouldn't speak on Wednesday.
Can you tell us what ultra-MAGA means? Ahead of the midterms, is that the line? Ultra-MAGA, what is that?
I think that's individuals that are very much so 100% in the camp of Make America Great Again, which is the former President Trump's side of the Republican Party. But ultra MAGA, I'm sure real time.
John, would you say goodbye to Maria?
No, I was actually going to check in with Maria just quickly, Tom, and see if she was okay. Maria, can you tell us what Tom has been saying and what you're meant to say when you say Javier's second name?
I actually don't. I can't even make the sound he makes. It's. I don't think I can, but what I do know, it's less. That's how you would say it.
Maria,
but I don't think I can replicate the sound.
How do you say Tadeo? How are we supposed to pronounce Tadeo?
Not Tadeo.
Well, if you say it in Spanish, it's Tadeo.
Can we clip this and just put it in the year-end highlights? I think this was special. Maria, thank you. Maria, today.
How do you pronounce?
I'm nervous saying Maria's name now.
Really, John? Yeah.
Anne-Marie Hordern.
John, keep it simple. How do you pronounce Tang?
Tang.
I've
got that one, Tom. You just have another drink. Futures down 2% on the S&P. On the Nasdaq 100 down 2.6. If you are just tuning in on TV and radio, we've had 5 weeks of losses on the S&P, the longest weekly losing streak going back to 2011. And hello, week 6, Lisa. More of the same.
And this is honestly what people are wondering. When do you get capitulation? Because yesterday, or I should say last week, this has been an interminable year so far. People not wanting to get out of bed, and yet it feels like it just drags together. How much have we seen true capitulation? Have we seen real forced selling? Okay, so when do we see it? What's going to trigger it? We've already seen such a
calls.
huge...
Doug Cass 101. Margin calls.
Why haven't we gotten
John,
them yet?
I need an emu export. This morning has been
I love how Lisa says people didn't want to get out of bed when Bramo's just talking about Lisa.
I'm sorry.
This morning.
I talk about myself in third person when
I
I'm
know.
tired.
I'm well aware.
I mean, come on. Did you want to
Some
get out of
people
bed
might
this
say
morning?
stocks should go lower. They are down by 2% on the S&P. This is Bloomberg. The longest weekly losing streak going back to 2011 on the S&P 500, going back to 2012 on the Nasdaq 100. 5 straight weeks of declines. As we kick off week 6, we head south. We're down on the S&P by 2 percentage points. On the Nasdaq 100, session lows again, down by 2.7%. It's get worse and worse as the session grows a little bit older. That's the equity picture. Here's the bond market story. 2s, 5s and 10s. Looking at 5s because a little bit earlier on, we took out highs we haven't seen since 2008. Yields coming back a little bit since then. By a basis point on the session now. On a 10-year, further down the curve, yields higher by 4 basis points on a 10-year to 317 after having a little look at 320 earlier on. Tom, if you go back to 2018, on a closing basis, the high was 323.73. Once you take out that, we're looking at the high since 2011. These are some big moves in this bond market.
Right now, John, and I want to go back to equity markets, and the bond market shows that as well. I'm going to do currencies here with George Saravelis in a moment. John, on the intraday chart on Nasdaq 100, down 2.7% on the futures. This morning's one of those mornings, John, you really got to sit on the futures. We have what's called log convexity on the futures, and what that is, John, on radio, I'm curving my hand, and what that means is you've got to curve to a lower price on Nasdaq futures.
As you and I are talking, Tom, we're making new session lows. That's the story with equities and bonds. Tom touched on foreign exchange. Let's take a brief look at what's happening right now. The dollar index, which tracks a basket of currencies but a heavy lean towards the euro. You know the story of that particular index. That's the strongest going back to 2002. Dollar yen, the highest since 2002. That's yen weakness. Dollar yen right now 131, euro dollar 105. But this hasn't been talked about enough, Tom, still. The weakness in China, the momentum in the US dollar, and the fact that sanctions, or rather the lockdown in China and sanctions in Russia, are starting to bite global growth. This is a story for dollar China, a move, Tom, of 0.9%. Now, I can't emphasize enough, a 1 percentage point move in the FX market is typically considered to be a big deal. Something happened in G10 if you see that. To see that happen in China, Tom, a managed currency, in the way it has done more recently, that is more than notable.
Well, they're repricing it. There's no question they're doing that to a weaker yuan, and that's one of the tools they have of a very different management of the process than you see in any other currency. I'd look tangential, John, to other EM. I'd look tangential to Korea, to Pacific Rim as well. Damian Sassower making clear he's watching Korea as a free market proxy of Beijing dynamics.
For global trade and for Chinese growth, it's always been the way, Tom. Dollar China right now, 672.83. Have you noticed that since equities have started going lower, that Lisa started covering single names, Tom? Have you noticed that?
I've noticed.
Yeah.
It's
Same story again this morning.
It's
down 2.7% on the Nasdaq with some single names, some stock movers this morning.
She'll
We can
probably
say good
pronounce them all
morning
correct.
to Lisa Abramowicz. Good morning, Lisa.
Good morning. Yeah, just I'm not going to go down the list and say sell, 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 although that might be what John expects
But
from me.
that's what you'd like to do.
Well, that's what's happening today, okay? So maybe what I like or don't like, what's happening is sell what you can, not necessarily what you want. I wonder how much that dynamic is leaving some of the highest beta and frankly most popular and biggest tech stocks to lead the way down. Meta might be creating a new universe today in its first physical store, but its shares down nearly 3% after a dramatically terrible year. More than a 30%, nearly 40% decline in the name. Amazon also down almost 40% year to date, and still massive declines as people take a look at what's ahead and where the growth will come from, especially with a consumer that is paring back and having some of the supply chain chinks. And Uber is an interesting story, down nearly 3% also, despite the fact that overnight we saw a reported CEO memo basically saying they're going to cut costs around marketing and other issues. So they're looking to that to try to generate more cash rather than growth. Again, not a positive picture. I also wanted to take a look at meme stocks because we talked so much about the retail trader getting involved, and Morgan Stanley did a report basically showing that those retail traders who got in at the beginning of 2020 have absolutely lost all of their money and then some. And we're seeing that again today. AMC, which is expected to report after the bell, down nearly 2%, not as much as the rest of the market. So maybe it's a haven, I guess, or at least a worst option. GameStop is getting absolutely terrorized this year and is down more than 50%, I believe now, down 4% on the session. And Ford is an interesting story. They were selling Rivian, John, those shares of that company. They're selling them at a discount. Those shares down nearly 3%.
Lisa, today isn't the day to sort of lay it on thick. I think the market is doing that for us. But have you been surprised by how few people have come out and talked about a bubble bursting in certain parts of this equity market?
You hear it on the edges, and people say that a bubble has burst. Some people say that it is bursting and that has more to go. I think it's actually a really important point. Is there an unraveling of a trade, or is it a reassessment? And are we shifting into the unraveling right now, where basically people are saying these valuations cannot last? And I do think that's a shift in sentiment, and it's happened over the past few weeks.
What do you make of that, TK? And Lisa, thank you. What do you make of that, Tom?
I just think you look at the data and there is a new allocation to the market, and it will come off of what central banks do. And anybody who's crystal ball gazing out to July of this year, July of next year, good luck with that. I look at our strategists, our forecasters that we have, and I say, good luck. I would notice, John, gold down $24, really indicating the sweat that's out there today.
To be honest with you, Tom, I think people are comfortable getting out to July. They're comfortable getting through summer. They believe that we'll see this year-over-year peak in inflation. It's after that for me. How much longer does this story persist for? And how much higher above neutral, what the Fed thinks is neutral, does this Fed need to go to? That's where the big uncertainty is for so many people. And that's why I think the likes of Morgan Stanley and Seth Carpenter are calling this one of the most unforecastable markets, economies in a long time.
Moment of silence for Michael Wilson, who looks like a genius here on a morning in May. Right now, what we're going to do here is look at what is in Michael Rosenberg's absolutely classic textbook, Currency Forecasting. If you'd like to buy buy it. It's $299, a hardcover edition, if you can find a copy out on Amazon, out on eBay. George Saravelis knows Michael Rosenberg is one of the founding heroes of currency forecasting, and Saravelis goes all Rosenberg. George, I'm absolutely thunderstruck by your behavioral analysis right now and how it folds into FX. Explain the behavior you're studying that gets you to a call on euro, that gets you to a call on dollar.
So I think, Tom, we just need to start off from the global growth environment, and that's really what's been driving the market over the last few weeks. And you have a perfect storm of weakening global growth in all regions. So in the US, you have this huge idiosyncratic tightening of financial conditions. In Europe, we have the war. And I think what broke the straw that broke the camel's back, so to speak, was the China COVID lockdowns, Shanghai, now potentially in Beijing. So you have all of the three world's biggest economies suffering from these shocks at the same time, and the market's bringing down growth expectations. And that's really what's driving things at the moment, including the US dollar, because you have the situation of lower global growth, but at the same time, US real rates are rising very significantly. And that's what's been supporting the stronger dollar over the last few weeks. If we're thinking about what would change that, we need to see an inflection in either of those three dynamics. So either China, Europe, or the US to change the current market environment and narrative.
George, have you changed your euro dollar call?
At the moment, I'm actually still keeping my optimistic euro forecast because I think, John, the market is too pessimistic on Europe looking out through the next 3 to 6 months. If you take a look at, there's a number of things the market's underestimating. The first one is fiscal policy. Everyone's talking about this big income shock in Europe, which is bringing incomes down. But if you crunch the numbers, more than half of the income shock is being offset because Europe is easing fiscal. And that's not what's going on in the rest of the world. And it will continue to do so through next year. Then you've got the reopening dynamic. Europe never reopened after the Omicron wave. The services sector never reopened. And that's exactly why, if you look at the services PMIs, they're holding up much better than expected. And then finally, you've got the labor market. The European labor market is actually stronger than the US. The unemployment rate is at record lows. So we think the ECB goes in July. I think the market has become too pessimistic in growth expectations. If you look at equity earnings globally over the last few weeks, Europe's actually got the best forward earnings guidance out there, much better than the US, much better than EM. So I think the euro will end up rebounding by the end of the year in the second half.
What's the catalyst, George, given that all of what you're saying is already known?
So I think it's interesting because if you look at price action, you are starting to see the euro turn across a number of other currencies. So for example, it's a risk-off environment, but Euro Swiss is now up on the year. Euro Sterling is starting to turn. So you are under the hood, so to speak, starting to see euro outperformance. I think you need a couple of catalysts to get that translated into the dollar. Firstly, the ECB coming into view, actually starting to hike rates. The market has been responding with lags to monetary policy repricings. So if you think about the dollar strength, we've known the Fed is tightening. We've known the Fed's doing QT for quite a while, but it's really now that the dollar's responded. And I think you can see some of that lagged response in Europe. So the ECB coming into view and potentially just some easing in all these sharp downward shifts to growth expectations that are supporting the dollar.
George, this has been a really tough trade. I'd really appreciate if we could catch up again in the next couple of weeks just to reset ahead of the ECB in about a month's time, because this one has been really difficult for a lot of people. George Saravelis there of Deutsche Bank, looking for that stronger euro, and that, Lisa, has been a massive struggle recently.
Even though, as we were hearing from George, there has been positive signs, and that fiscal spending is key. The idea that suddenly we're getting an acceptance of spending money that has nothing to do with the pandemic, but rather military spending, green energy spending. This is a new shift, which should be positive for the economy, John.
Did you see the story out on the ECB on Christine Lagarde? Great reporting from the team over in Germany. President Lagarde rejected calls by staff at the ECB to link their salary increases to inflation. In an email to employees on May 5th, seen by Bloomberg, Lagarde said she understood that some were disappointed by this year's rise, but insisted that future adjustments must be, Tom, quote, reasonable.
You wonder, are they writing the same letter at the Eccles building in Washington?
Hey.
Are we going to see, you mentioned it last week, John, the wage negotiation in Europe is not to be underestimated.
Do you remember that line from Governor Bailey in the last few months? Do you remember that, Lisa? When he turned around and said, perhaps don't ask for a big pay rise.
Yeah, because it's bad. Right. So basically, you're going to get a pay cut in real terms.
It's uncomfortable when central bankers have to talk about this stuff. Let's just put it that way. I'm being diplomatic for once.
Yeah, I was about to say.
The S&P down about 2% and the Nasdaq down 2.5. I don't think it's going to last long, Tom. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Vladimir Putin invoked Russia's fight against Nazi Germany as he defended his faltering invasion of Ukraine at the annual Victory Day celebration. He said the Russian military is defending, quote, what our fathers, grandfathers and great-grandfathers fought for. An advisor to Ukraine's President Zelensky responded on Twitter saying that the Russian army is dying, not defending their country, but trying to occupy another. U.S. First Lady Jill Biden made a surprise visit to Ukraine. Biden had been on a trip to Slovakia when she crossed into the western part of Ukraine, where she met with displaced children and the wife of President Volodymyr Zelensky. Biden said the timing of her visit, which coincided with Mother's Day, of course, was important to her. And the U.S. government had a record tax haul this spring, and some of the credit goes to the surge in individual stock trading by Americans. According to the Treasury Department data, tax collections since the start of the fiscal year in October are running at a record high, up some 43% over the same period in 2019. That surprised Wall Street and is shrinking the budget deficit. And in the Philippines, polls indicate the son of the late dictator Ferdinand Marcos is poised to be elected to president today. Ferdinand Marcos Jr. has been helped by a barrage of online propaganda painting the tough martial law years under his father as a golden era. His main rival, President Lenny Robledo, says there's concern over malfunctioning voter counting machines. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
The Fed doesn't often manage to bring down inflation without triggering at least a small recession. I think particularly then when you have inflation this high and when you have a labor market this tight, trying to bring inflation down in that context is going to be hard to do without a brief recession.
Interesting comments there from Randall Quarles there, the former Fed governor, speaking to Bloomberg's Mike McKee. Mike McKee with the Atlanta Fed president, Raphael Bostic, in about, 15 minutes from now? Looking forward to that. From New York City this morning, good morning. Equity futures down by 1.9% on the S&P. On the Nasdaq 100, down 2.5%. Looking ahead to CPI on Wednesday. This from the team at Citi, led by Andrew Hollenhorst. They say this: CPI inflation is the most important data release this week. We expect, month on month, a 0.4% core reading to show underlying inflation is not slowing materially, despite a mechanical drop in year-on-year readings. And Tom, this is how we'll frame this Wednesday. The year-over-year story, set to see a mechanical peak. If it wasn't last month, it'll be maybe this month. But the month-on-month readings is where the focus of this market will be into Wednesday and beyond. It
will be into the Wednesday inflation report and some of the other niceties that we'll see on to the ECB meeting. And right now, speaking of the ECB, we do a bit of a focus on Europe. Kriti Gupta with a chart on Europe. Kriti?
Yeah, Tom, a little bit of a scary precedent when you talk about the growth story that you and John were just discussing. In the United States, you are seeing markets globally sell off, but in the United States, the economy somewhat insulated from that. You can't say the same about Europe, and that brings me to my chart of the day, showing an index of credit default swaps, otherwise known as insurance, on investment-grade firms in Europe. Those swaps are now topping 100 basis points. Tom, if you go back in history and see the last time it's done that or crossed that threshold, it was March of 2020 with the onslaught of the pandemic. It was the start of 2016, really coming off Fed tightening and growth fears in China as well. And then going back to 2013, essentially the sovereign debt crisis over in Europe as well. So we aren't exactly crossing a nice spot here. And this isn't necessarily just inflation. It really comes down to one thing and one thing only, Tom, and that is the war in Ukraine.
And the war in Ukraine really front and center today on food prices. We see it, of course, with India's intervention here about 90 minutes ago, perhaps a resignation of the leader of Sri Lanka about an hour ago. show. These are the dynamics we face in early May. And on this May 9th, as Mr. Putin confronts May 9th, all of Europe does as well. With perspective, Leslie Vinja-Murray, Director of U.S. and America's Program at Chatham House. Leslie, you and I were talking about the wonderful Anne-Marie Slaughter and about the need to get to some form of Eastern European integration. How do we get from a non-integrated Europe to an integrated Europe in this new Europe?
Well, this is a conversation that really needs to have. I think the piece by Anne-Marie was excellent in pointing that out. And note, that what she said is very clearly true. It's going to be very difficult to do that in the current moment. Even getting to some sort of idea of how there will be a negotiated settlement feels very remote. It feels like this war will run for a long time. But the unity across the West, the drive by Finland and Sweden potentially to move into NATO means that, the unintended consequence of all of this could be a hardening of the lines between the East and the West that will stay with us for a lot longer even than this war. And that, of course, would do none of us any favors as we look ahead.
Leslie, General Kimmett, channeling Robert Gates, spoke of our holiday from history. We've all gotten used to, from February 24th, the end of the holiday. What does this May look like in Ukraine? What are you watching from London?
Well, right now there are multiple things we're watching. Obviously, we're watching the fight on the ground as it moves to the east. But I think really one thing is, are we seeing a serious conversation about how to bring this war to a close? I think most people are very pessimistic, see it run potentially for as much as several years. And the real sticking point is, what will the stated goal be? And that's gonna require not only some indication that Russia can come to the table, but also some indication that Ukraine will come to the table. And right now, the war aims, both of Ukraine and also of the Western partners, that coalition that's backing Ukraine, aren't signaling any intent that looks like it makes that kind of negotiation possible. It feels a very long way off. At the same time, of course, we're seeing that that push for sanctions. On the one hand, it's moving forward. We've seen more sanctions from the U.S., from the UK on professional services, on export controls, but we're not seeing those energy sanctions, and the EU is really struggling with that. We've seen Hungary really dig in. I think that the numbers are 44 billion euros, I believe, worth of imports into the EU, of energy imports into the EU since the war began. So a lot of mixed messages coming out of the West, despite a really tough rhetoric.
As Russia holds that military parade, and we did hear from Vladimir Putin, can we look at how much NATO has really solidified its union, it's solidified its camaraderie and its power? Is there a substantial reshift back to Western power, or has that been highly overstated?
No, I don't think it has been overstated. The U.S. has doubled down on its commitment to the transatlantic partnership, to NATO. The U.K. has come in very strong. Europe has come in very strong. As we mentioned, Sweden and Finland are now looking to join Europe. But there is a question of effectiveness. What does it all amount to? Certainly, Russia has not had the success. We all know this. It hasn't had the success that it wants, but the war continues. It's been, in a couple of weeks, we'll hit a 3-month mark. The cost globally has been extremely high. Clearly, the highest price is paid by the Ukrainians. But there needs to be some realistic and pragmatic solution that can bring the war and the associated costs to a close sooner rather than later. And that right now feels very remote, in part because the West is so strong. We have mixed messages coming out. We have the British Defense Secretary talking about containment. We have a conversation coming out of the U.S. about weakening Russia. It's not yet clear exactly what the aims are of the West, of NATO. Those need to be articulated and said and resaid in a way that's clear, that's aligned, and with some notion, and this is a really tough part for all of those who really feel and are sympathetic in a deep way for the pain that the Ukrainians are facing. Still, there needs to be some sort of message about what Ukraine will have to be willing to consider in order to get to a peace agreement, and that's important. And final point here is, in the medium and long term, letting the people in Russia understand that they have a future as part of the European security arrangement, that this is an effort to really put Putin back in place. That's absolutely essential, but it's not a war on the people in Russia.
Leslie, thank you. We're fortunate to catch up with you so often. Leslie Vinjamuri there of Chatham House. Crude this morning, negative 2.6%, a break of 110 on Brent, 109.47. WTI down about 2.8 percentage points. We are down to 106.65. Coming up on this program, a conversation you do not want to miss. Bloomberg's Mike McKee sitting down with the Atlanta Fed President Raphael Bostic. That conversation coming up very shortly, with the S&P down by 1.7%, just off session lows on the Nasdaq 100 down by 2.25. Yields higher by 5 basis points on a 10-year to 3.1766, just south of 318. From New York City on TV and radio, this is Bloomberg.
The whole point of what the Fed's trying to do is to make sure it doesn't turn into 70s inflation with a wage price spiral.
What they're really trying to say is they're on the case of inflation.
We do expect inflation to start to moderate more meaningfully in the back half of the year.
If you look around the world, everybody waited too long.
It's going to be very choppy the next few months in the broader financial conditions as well as interest rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. An eventful Monday like the eventful Friday, the eventful Thursday we had last week. Markets on the move, and John, they are not as grim as 20 minutes ago, but these are difficult equity markets.
That's the only sprinkle of good news you've got, Tom. Off session lows on the Nasdaq 100, down 2.3%. On the S&P, down by 1.7%. I think Seth Carpenter at Morgan Stanley absolutely nailed it over the weekend into Monday. We live in the most chaotic, hard-to-predict macroeconomic times, Tom, in decades.
We're going to get you up to speed on that in moments. Our Michael McKee with Bostic of Atlanta. John, Atlanta GDP now situated well below 3%. Seems to be an American economy returning to something like normal.
Looking ahead to decelerating growth, Tom, and hopefully looking ahead to decelerating inflation prints as well. CPI is the big one this week, Tom, this Wednesday.
Of all the research this weekend, John, I think the thing we need to stop and parse here, Michael McKee has read it from Palo Alto down to where he's ensconced in Georgia, and that is the Jan Hatzius piece saying, forget about now, look out further to disinflation.
That seems to be the consensus view, that we've all seen a year-over-year peak in inflation in America. If not the last month, perhaps this month, maybe the next month. But Tom, it's about the month-on-month readings in core CPI that this market will be fixated on this Wednesday. That's what we're going to be looking for.
Lisa, the president is fixated on inflation.
How much can he really do at this point? They've already done this Strategic Petroleum Reserve release. They've already talked about possible profits at oil companies that have surged, but at the same time, it's not necessarily economic for them to invest in drilling more. What can he do against supply chains in China? What can he do against war in Ukraine? And I think that goes back to what John was talking about with Seth Carpenter of Morgan Stanley. The uncertainty stemming from things well outside of policymakers' control is what's really whipping around a lot of the market activity, as well as, frankly, economic forecasts.
But in aisle 4 of your local grocery store, Lisa, the Fed debate is 4% inflation okay, 3% acceptable, or the nirvana of getting back to 2%. That doesn't play in aisle 4, does it?
It doesn't play, especially when real wages continue to be so deeply negative. And this is the concern. How do central bankers continue to message that wage gains are perhaps bad for long-term inflation when it is the only way for people to actually survive and have it be actually a quality of existence?
Before we go to Michael McKee, John, we must do a data check. I'm looking at a VIX up 4 big figures. We had a 34 level on VIX about 24 minutes ago.
Volatility in the driver's seat once again, TK. Let's whip through it. Your equity market is lower, negative, down, headed south on the S&P by 1.8%. On the Nasdaq, down by 2.3%. As we say, the good news, off session lows. Yields higher by 4 basis points on a 10-year, 3.17. The highest we've seen this 10-year a little bit earlier, through 3.20 for the first time since 2018. On a 5-year, yields just a little bit lower now by a basis point. But Tom, at one point today, the highest 5-year yield going back to 2008, and we haven't even talked about the strength we've seen in the US dollar.
Absolutely not. We need to get to this conversation. We do so as every Fed president seems to be different. John, it's somewhat comforting to know that as Mr. Bostic passed economics in Harvard, he also took a degree in psychology. That's perhaps helpful at this moment.
Very happy to say, sitting alongside Bloomberg's Mike McKee. Good morning to you, Mike.
Good morning to you, John. You guys are really depressing today, so maybe we'll ask Raphael to use his psychiatric degree to try to cheer you up or something. Raphael Bostic, president of the Atlanta Fed, thank you for joining us this morning. Wall Street also depressed, as you heard there with the numbers that they were just giving us. The two questions that everybody on Wall Street wants to know is how far, how fast? And so let me start with that to get the good stuff out of the way here. Is 75 basis points really off the table? Is 50-50 and maybe another 50 going to be good enough? And then how high do you think you end up going?
Well, first of all, good to see you, Mike, and it's good to have you here at our conference. It's always a great time to be together. You know, when I think about our policy, the first thing that is on my mind is that inflation is too high, and we need to act definitively and purposefully to try to get that under control. And I think if you look at what we've done so far in the last two meetings, we've really started that process. For me, 50 basis points from over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively. I think we can stay at this pace and this cadence and really see how the markets evolve. My expectation and hope really is that as we move closer to our neutral levels and far away from our accommodative stance, that we're going to start to see a lot of the tightness and the tension in the economy start to moderate, which can then give us options and choices as to sort of what we do after that point.
How far do you go? Where do you think you'll be by, say, the end of the year or by the end of 2023?
Well, that's a very good question. I really think we need to be getting somewhere into the neutral range. And as you know, different people have different ideas about what that looks like. For me, I'm looking somewhere between 2 and 2.5% as our neutral range. And then let's just wait and see what's happening. In the intro to this segment, a lot of discussions about uncertainty, or Seth Carpenter was referenced. He's going to be here. I'm really excited about that, saying that there's a lot of volatility, a lot of stuff that's going to play out. So once we get to that neutral level, I think that'll be fine. We're going to, in my view, we're going to move a couple times, maybe 2, maybe 3 times, see what happens, see how the economy responds, see if inflation continues to move closer to our 2% target. And then we can really take a pause, I think, and look at how things are going.
Well, take a pause. What does that mean? Not move at a meeting, or would this be just a rolling decision as you go along?
So for me, I think all options are on the table at every meeting. So depending on how the economy is responding, it could be that the economy is responding strongly, so we don't need to do anything. It could be that the economy is responding maybe a little less strong, so we might move to 25 basis points, or we may stay at 50. So I'm really going to keep my mind open. I'm going to observe what happens in the economy and then adapt my idea about what appropriate policy looks like based on that knowledge.
A lot of economists and many of your colleagues have said you're going to have to go beyond neutral to restrictive. If you had a 4% inflation rate and a 3% Fed funds rate, you've still got a negative real Fed funds rate. Why don't you think that you're going to have to do that?
Well, my hope is that a lot of the things that are really out of our control, things like supply chain disruptions and the like, are going to start to get to a better place. We're going to see how the labor market responds. There was a story just last week about retirees coming back into the workplace. Those are things that might relieve some of the tension that we're seeing in labor markets and allow producers to start to increase their supply of products. That then reduces the imbalance between demand and supply, because all of this inflation is about an imbalance between the high demand and the low supply that's out there. So if we can start to see movement on the supply side, that means we'll have to push less on demand. And so that inflation, I'm hoping, will come down. Now, how fast, we'll have to see, and that will really determine whether we have to get into restrictive territory, and if we do, how far. But I'm totally open to that, but I'll just say, we've been doing surveys throughout the entire pandemic. everyone has come with predictions that have turned out not to be the case. So I'm going to try to be as humble as I can, be really just true to being in the moment, and try not to anticipate too many steps out in advance, because there's just a lot of stuff that's going to happen.
You heard the markets at the top of the show. Does it worry you that we're seeing such a rapid sell-off and that market rates are going up so quickly?
So those are two different things. So one, I think the move in market rates is actually quite interesting, because we've not moved very far in terms of our policy rate, but the markets have responded extremely fast. And that, I think, that's really positive from my view, in the sense that they're taking on board the policies that we've signaled, and now we've just got to deliver on that, and I think we're going to do that. In terms of the volatility in equity markets, you know, one of the things that I found to be very interesting is, as I talk to a number of people, the range of forecasts about what's going to happen over the next 6 months, the next 12 months, has just really broadened considerably. And that will translate into, I think, higher volatility. And I think some of what we're seeing right now has to do with that.
What would it take for you to have to rescue the markets? A lot of people say, let's just say the economy, not the markets, that you get to 2023, you might start cutting rates again.
Well, look, there's a lot of momentum in the economy right now. We just had a jobs report at over 400,000 jobs in the month. That kind of performance in the before times would have been a reason for celebration. So I think we can ride out a lot of that momentum even as we are raising rates. And my hope is that we'll get to a place where we don't start to see breakdowns in labor markets or other parts of the economy, such that we won't have to worry about that. But just to be clear, like, we are paying attention. I am paying attention, and if necessary, we'll do whatever it takes to make sure the economy stays on a solid path.
Well, I know if I ask you about the recession probability, your job is to say, no, I don't think that's going to happen because you're at the Federal Reserve. But a lot of your former colleagues, including Bill Dudley and Don Cohn, have said you cannot do this without inducing a recession.
Well, you know, I was interviewing Roger Ferguson just last night, and he said the same thing. So yes, I am hearing all of that, and I understand that. I actually think that the thing we have to just be mindful of is that this context is nothing like we've ever seen in my lifetime, in my policy space. The pandemic-driven disruptions, we have a war in Ukraine. There are a lot of things that are intersecting in ways that I think make it really hard to know with any kind of certainty where the economy is likely to go. So I'm keeping my mind open. I'm an optimist, but a worried optimist. I worry all the time, and so I'm just going to pay attention to see where things go.
One last very quick question, and that is, it's an election year. There's a lot going on. Do you feel any political pressure?
I'm not feeling any pressure. Look, we have a clear job to do, and that's meet our dual mandate. Today, the labor market's doing fine. Inflation is where we really have a challenge, and so we just need to do whatever it takes to get that inflation under control.
Raphael Bostic, thank you very much for joining us this morning from the Financial Markets Conference at Amelia Island, Florida, where everybody is back together for the first time in a couple of years. John?
And I hear it's beautiful too, Mike, which is why you're so happy and not so gloomy, because you don't have to follow this market either. Mike McKee, thank you, buddy, as always. Your equity market recovers a little bit, still negative 2% on the Nasdaq, on the S&P down by 1.6. Let's go over these headlines, Tom. No need to hike more than 50 basis points. Get back to neutral, 2 to 2.5. The economic tension starts to moderate. Then you can pause and reassess things, and we're open to going higher if needed. This is basically the consensus view on the Fed. It's what happens if they get to 2 to 2.5, where all the uncertainty lies, Tom. That's where all the uncertainty is.
Just what it is. It's a consensus view, and it adapts and adjusts as you move forward. I thought Jeff Rosenberg was just brilliant on this between the Fed meeting and the jobs report last week. And John, it's buttressed by news, and there's the news. Why did the market lift here? It didn't lift off Mr. Bostic. It lifted off Mr. Scholz in Germany, talking about getting to those oil sanctions, whatever, that Germany's battling on. And that's just one breath a moment here in a very difficult market.
Up next on this program, we catch up with the White House, Wally Adeyemo, the Deputy U.S. Treasury Secretary. The view from the administration next.
Inflation is too high. and we need to act definitively and purposefully to try to get that under control. For me, 50 basis points from over the last 20 years, is already a pretty aggressive move. I don't think we need to be moving even more aggressively. I think we can stay at this pace and this cadence and really see how the markets evolve.
A fantastic lineup of guests through this morning. A special thanks to Mike McKee sitting down with Raphael Bostic, the Atlanta Fed president. From New York City this morning, good morning with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Your equity market negative once again. On the S&P, we are down. We're negative 1.77%. On the Nasdaq 100, down by more than 2 percentage points. The good news, it was almost down 3 in the last hour, so things getting just a little bit better, relatively speaking. Yields up by, let's call it 3-4 basis points, Tom, to 316.27. On a 10-year.
Now, we'll have to see. It is a better tape, John. I don't even know where to go with it, John. 3.16 on the 10-year yield. I guess I can say what? A slightly weaker dollar here, John, in the last 40 minutes?
Yeah, relative to where we were, once again, Tom. But we are really going to levels we haven't seen for a long, long time and haven't seen very often in the last decade or so. Take the 10-year Treasury to go north of 320 earlier on this morning. You've got to go back to 2018 and before then, 2011.
Any morning with the VIX up 3.55% is where you do more data checks. Right now, we will migrate to Washington. Wally Adeyemo joins us, U.S. Deputy Secretary of the Treasury, and far more someone who knows the minutia of sanctions. Wally, I want to cut to the chase, not the broader, bigger picture, but the details of the Office of Foreign Assets Control. This goes back to Albert Gallatin, the War of 1812, and we drag it forward to some 200 employees in the Office of Foreign Assets Control. What is that office doing in Treasury to defeat Mr. Putin?
Well, thank you for asking about the career civil servants who work in the Office of Foreign Asset Control. And today what they're doing is they're working to target the Russian military industrialized complex. They've taken a number of steps already to go after the Russian financial system, and we've seen their economy is contracting by more than 10% due to that. And now we're focused on making sure that any money that remains in Russia can't be used to further build out their military industrialized complex and be able to fight the war in Ukraine. Today, because of the actions the Office of the Foreign Asset Control has taken, the 2 top tank makers in Russia aren't functioning because they can't get access to the goods and the services they need to do the work that they're doing. And yesterday, we sanctioned some of their top military companies as well.
And Wally, what's so important here is the media is, there's a yacht, it's Mr. Putin's yacht or it's somebody else's yacht, and we've got all the silliness about boats floating around. In that office, did they call up, say, a manufacturer in Poland and say, wait, you can't do that? Or are they just domiciled in America?
So what we've done is that not only have we taken actions by talking directly to the financial system and making sure that they're aware that they can't provide services to the people who help build those yachts or help fuel those yachts, but we've done this action in collaboration and coordination with our allies and partners. So not only can you not domicile your yacht in the United States, but across the G7, across 30 countries have taken these actions. And what we've also said is that if you happen to get your yacht to another country, and in that country you're able to find a company that will provide you with services, if that company provides you with material support, we're also going to sanction them as well.
Wally, we're at a time where we're dealing with the idea of sanctions on Russia, but also the idea of incredible inflation and possibly removing certain Trump-era tariffs on China in order to reduce those inflationary pressures. How actively is the Treasury Department discussing some of those types of removals at a time when people are wondering about the U.S.-China relationship in light of what's happening with Russia?
So our goal is always to make sure that we're making trade policy in a manner that's consistent with our overarching goals. And what we're doing is we're working closely with the U.S. Trade Representative and the rest of the President's cabinet to make sure that we have an approach with China that puts front and center America's interest. And not just America's interest. When you look at the issues we have with China, there are issues that other countries have as well. So working closely, as the President said, with our allies and partners as we think about our China strategy.
Going forward, what do you think is going to be the next step with respect to additional pressure put on Russia, especially given some of the inflation that we're seeing?
The reality is that when you think about what Russia is doing in Ukraine, it is a key contributor to some of the price increases that we're seeing both in energy and in food. today Russian ships are blocking the ability of food to get out of Ukraine. Because of Russia's actions, you've seen energy prices rise because of the geopolitical uncertainty. So what we're trying to do with our sanctions is to end that invasion as quickly as possible. And where we're going to go next is we're going to continue to put pressure on their financial system. We're going to go after their military industrialized complex so that Russia doesn't have the arms they need to continue the war in Ukraine, but also so they can't project power into the future and continue to destabilize the region and the world.
We've got reports on the Bloomberg terminal, Wally, that Russia's seeing a 12% contraction. Do you have any idea, can you model out what form of contraction you visualize? Can it be negative 18%? Can we get there?
So what we know today, based on what the IMF and what others have told us, is that Russia has lost about the last 15 years of economic growth due to the sanctions we've imposed on them to date. And that's not even talking about the inflation that is going through their economy. The truth is that Russia now has to make choices, and that's exactly what we want them to do, to have to choose between using their resources to prop up their economy or to fight their war in Ukraine. And we want to continue to make that choice even harder by continuing to level sanctions until the invasion ends.
Wally, good to hear from you. As always, come back soon. Wally Adeyemo there, the US Deputy Secretary of the Treasury. The interviews continue this morning. Ian Shepperson of Macroeconomics is joining us very shortly. Pantheon Macroeconomics, with two views here that maybe things can get better on the inflation front sooner than this market expects. But also, he had this to say last week. This is a generational shift up in yields. Sell the rallies. Looking forward to this one, TK, moments away.
Well, the generational shift is there. What's interesting in the Hatzius call of a more quiet inflation is he models out a year or so that goods inflation disappears, within an exaggeration disappears. John, that's a terrific bet.
Is peak inflation enough? Lisa, it's a prerequisite to things settling down, absolutely. Is it sufficient? I don't think a lot of people believe it is.
It depends also what's going to drive the deceleration, because it's not coming right now from rents, and it's not coming right now necessarily from wages. If it does come from wages, is that a good thing? Is that something that people are going to want to see? People want to see it come from the supply chain disruptions, and that's not happening right now given some of the geopolitical developments.
Yields lower at the front end on a 2-year by 5 or 6 basis points, higher at the longer end on 10s and 30s. A lot to figure out here in the bond market. In equities, yields up, equities down on the Nasdaq 100 by 2.24%, on the S&P 500 down 1.7%. And in foreign exchange, Tom, we keep going back to it. The dollar rip-roaring strength over the last 5 weeks.
Oh, big strength 3 hours ago. It's ebbed away. You got to watch yen. A 131 handle earlier, 130.69. Weak yen from February 24th.
And the dollar turning negative now on the session, as Tom indicated, and euro dollar just about positive. Looking ahead to an ECB meeting next month. From New York City, this is Bloomberg. Live from New York City on TV and radio, this is Bloomberg Surveillance with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Your equity market is lower, down 1.8% on the S&P. On the Nasdaq 100, negative 2.3%. Yields are higher, but not as high as they were. Up a basis point or two on a 10-year to 314.67. The dollar was a whole lot stronger, now weaker against the euro, Tom. Euro dollar 105.63. That currency pair, positive 0.1%.
Right now, let's recalibrate here as we do within this market turmoil. We'll do more data checks for you as we see the data come in. Maybe Mr. Scholz in Germany moving the markets with comments on oil embargo after a difficult election. Ian Shepperson parses the American economy like no one. He's chief economist at Pantheon Macroeconomics and joins us for a recalibration this morning. Ian, we just spoke to Raphael Bostic, who gave us the Fed line from Atlanta of the good news out there. We're in control. We have options. How much in control are our central bankers?
Well, maybe a bit more than markets think, actually. Of course, they would always say they're in control because if they say anything else, then all hell breaks loose. And the last few months have been, very difficult for them. Inflation hitting some really big spikes, but we've probably hit the peak. And my guess is when we get CPI numbers later this week, they're going to look significantly better year over year, maybe month to month as well. And then the next few months, that good news should continue. So I think they're going to be able to tell a story later in the summer of, hey, what we've done is working. Of course, what's actually happening is the very favorable base effects are kicking in, and that will bring inflation down. Then I think they're hoping that the downshift that we seem to be getting in the wage numbers in the last few months will persist, and that will help them through the end of the year with some genuine downshift in services inflation. Still some big question marks there, but the last few months' data, I'm guessing, have been better than they expected.
How important to the late summer into the end of the year view is escaping the Chinese lockdown?
Well, you know, that's a big deal for some small sectors. You know, the US CPI is primarily a domestic service price index with a few goods in it. Now, quite a lot of those goods are China sensitive, so things like clothing, footwear, furniture, appliances, household electronics. But you add those things together and you're still looking at less than a tenth of the index. So if we're getting some meaningful disinflation in some of those other components, that I think will offset the supply disruption story. Plus we've got some extremely favorable base effects in the vehicle component, which will be pretty much a done deal to be a big downward shove to the year-over-year numbers. So actually the China thing is not helpful, but I don't think it's a game changer as long as it doesn't get completely out of control.
Ian, we're teasing out your view here. Let's really highlight it. A lot of people, the consensus view, because Fed Chair Jay Powell basically clarified it, 50 at the next meeting, 50 after that. Have you got any doubt around that second 50? And if you have, can you explain it?
Yeah, I mean, the first 50 in June, I think, is a done deal, barring some sort of sky falling in moment. But July, you know, by July, we'll have had 3 CPI reports, all of which will show inflation dropping by about 0.5 point per month. We'll have also seen 3 more months of housing data, and this is where I have a really big gripe with the media narrative that the US housing market is still booming, because it isn't. Mortgage demand is absolutely cratering. I mean, rates have gone from 3% to 5.25%. There's no way the market could take that. And every week we get mortgage applications numbers, and they're terrible. I mean, applications fell 10% in April alone. No sign of a bottom. They still haven't fully responded to the peak in rates yet. And my guess is that over the next few months of spring and into the summer, we're going to see some really startlingly weak numbers on home sales, suggesting that the market is really rolling over. I just wonder in July whether the Fed will have the stomach, after 3 good inflation reports as well, to do another 50, and whether the market will want them to do another 50 against that backdrop. So there's a lot to play for over the next few months, but I do think that 2 of those very important things, inflation and housing, are going to be telling the Fed, maybe, you know, you can switch back to the 25s a bit sooner.
Are you questioning the journey to 2,250, or are you questioning the ultimate destination of getting to 2,250 here, Ian?
No, I'm not. I mean, my beef with markets is they've got far too aggressive on the speed that the Fed needs to go. I'm not arguing at all with the idea that rates need to be significantly higher. And I actually think they'll be raising rates again in 23 and 24 because the neutral rate will be rising on the back of stronger productivity. And that's a different story to raising rates because you've got behind and inflation's rampant and everyone's panicking. That's this year's story. But next year's story, you know, I could see rates going significantly higher really across the whole curve. So my beef with markets is they've been maybe too aggressive for the short term and not thinking enough about what might happen next year as well. A different glide path, but nonetheless, you know, a rising rate environment. A normalization, if you like, after such a long period, you know, decades of falling rates, real rates across the whole curve. Maybe we're moving back to something recognizably normal.
Ian, I'm wrapping my head around the scenario that you're portraying, where basically wages start decelerating, and that is actually one of the key drivers, in addition to housing, that causes a deceleration in inflation. Is this a good thing? Does this lead to something that is positive for the Fed, or something that sounds stagflationary because we still have the base effects of what's going on with supply chain disruptions?
Yeah, I mean, from the Fed's perspective, the wage numbers that we saw last summer when they were running annualized above 6%, that was not sustainable. That scared the pants off them. You know, Chair Powell said that very clearly. Where we are now in the last few months, it looks as though, tentatively, wage growth could be settling down at something like 4 or maybe the high 3s. Now, that is faster than we saw at any point in the last cycle, but that was a very unusual cycle. Wage growth at that pace would be normal for previous cycles and would be consistent with the inflation target if productivity growth just picks up a little bit. So it's kind of a sweet spot if we can engineer it against this backdrop of chaos from China and all the other stuff that's going on as well. But if I were at the Fed thinking about inflation, you know, 1 1 to 2 years down the line, I would be thinking if wage growth settles at 3.5% to 4%, I'd be really pretty happy, because it's not what I was imagining 3 months ago. I was thinking of 5+, and that's a much more scary place to be. So it's a plausible endpoint, but it's not yet certain.
I apologize to harp on this, but is it the absolute number or is it real wages? This idea, I hear Tom laughing, but this, to me, it's sort of a relative kind of equation here in terms of wage gains versus the cost of goods. Because if you're only getting a 3% wage increase, but the cost of goods are surging at 10%, this isn't looking very good for the American public, and it doesn't necessarily look good in terms of consumer dynamism.
Well, you've got to remember that the U.S. household sector is sitting on $3.5 trillion of cash that it accumulated during COVID, which is about 14% of GDP. Cash. That's not taking account of the rise in home prices or the rise in other asset prices like stocks and everything else. That's a gigantic cushion when you set against, having to spend a couple of $100 billion a year more on food and energy. So overall, the household sector is in pretty great shape. There are some questions of distribution, who has this money, who doesn't have it. But overall, the household sector is in really good shape. And of course, remember, if the CPI numbers are going to moderate to core prints of 0.2 or 0.3 over the next few months, then real wage growth stops falling more or less immediately. I mean, for example, this week, the CPI is going to be a 0.1 or a 0.2 at the headline level, while wage growth this month is going to be a 0.3 or a 0.4. So we're past the worst of it. It's not great, and year over year it's down, real income growth is down. But we're moving into, I think, a better position. And we do have this gigantic cushion of accumulated savings and the transfers that the federal government made under COVID. And that makes this income squeeze from food and energy prices very different to previous experience when that cushion just wasn't there.
Ian, take your optimism, and this has been hugely beneficial within the gloom. Take your optimism over to export and import dynamics for America.
Well, we've seen some insane import numbers over the last few months, which was a big drag on growth in the first quarter. But I'm guessing, and looking at the data, it seems pretty clear that this is substantially because domestic retailers, domestic wholesalers are rebuilding inventory after really struggling during the peak goods spending frenzy of COVID. So this won't last for much longer. I mean, we've seen record trade deficits in the last few months. That's completely unsustainable. And my guess is that the trade numbers will be a lot quieter over the next few months. That's on the import side. On the export side, we're going to struggle for the foreseeable future because the dollar has shot to the moon. Europe's teetering on the edge of recession. China's in chaos. Yes, it's not a great environment to be an exporter. But again, remember, the US economy overall is primarily a domestic services economy. That applies to growth just as much as it applies to inflation. I'd like to see strong exports, but it's not the end of the world if they don't happen. And certainly for the next few months, it's going to be difficult.
And we did this whole interview without talking about Newcastle United.
We did.
Wasn't that a beautiful thing, Tom? I think he owes us for that.
I did.
Did you watch that game, TK, yesterday?
No, I did not.
That was special for Man City, not so much for Newcastle United. Special summer maybe coming up in the transfer market. Ian, we'll leave it there. We'll catch up soon. Ian Shepherdson there of Pantheon.
You finesse that nicely.
Macroeconomics. Thank you, TK. I'll be catching up with Stuart Kaiser of UBS a little bit later this morning around the opening bell.
Are we leaving Tuesday night or Wednesday
to where,
night
Tom?
for the Derby?
Oh, you want to get out there for Arsenal Spurs?
Yeah, for the Derby.
Is Stuart Kaiser coming with us?
Yeah.
I haven't got tickets for it, Tom.
Well,
and I haven't seen it signed off by management
I'll
either.
call Harry.
I saw your email.
Yeah.
Maybe we could find some tickets.
Yeah.
Do you still want to go?
Well, I mean, I would call the Tots and see what they could
What, Daniel Levy
accommodate.
gets you a couple of tickets for the big game Thursday night.
I want to get one of those fancy coats and sit like 4 rows back behind the bench.
What is a fancy coat?
Oh, I don't know. They have these fancy designer coats they wear.
The Moncler ones?
I don't know.
Okay,
Each
I'm
firm
just
is
wondering
different.
what you're talking about.
I mean, I've never been to a soccer game, John.
We've got to change that. We have got to change that. Maybe we take a week off. I'll take you to
Go
Spurs.
to Newcastle?
Spurs Arsenal Thursday night, and then we'll go and watch AC Milan on the weekend.
What is the derby that Newcastle plays?
They play against Middlesbrough, but they're in a different league, Tom. Or Sunderland. They could play Sunderland too, but again, those kind of teams go up and down.
Encyclopedic.
Into the Premiership and down again.
John.
Sure.
Yankees, Mets, crushing it.
Red Sox?
The only reason the Red Sox aren't worst in world are the always beloved Detroit Tigers.
Would you like the Bramo baseball take?
The Mets
please,
take?
No, it's okay.
I would love the Bramo baseball
No, it's
take.
okay. Please, just keep your moment of zen going. I mean, I know that it's depressing in the market, so keep going with
You're
that.
calling this a moment of zen?
I don't know. I don't know what else to call it, frankly.
Come on,
That's,
Lisa, it's Monday boy talk. I mean, come on, we're catching up.
Okay, is that your segment, Monday
We didn't
boy
get to talk over the weekend. In fact, you didn't text back, Tom.
No,
What's that about?
You're right. This isn't a
I was
moment of
completely
zen.
overwhelmed by Mother's
Keep writing
Day.
your book on meditation, John.
As soon as the Spurs goal went in, I thought Twitter would light up, my phone would light up, but it didn't.
Mother's Day was deeply emotional.
Sounds it.
In which way?
Expensive for TK. It's usually what deeply
the
emotional
offspring
means.
actually spoke to me, which was great.
Congrats. Futures down 1.8 on the Nasdaq. We recover a bit on the S&P 2, down by 1.4. And this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Vladimir Putin invoked Russia's fight against Nazi Germany as he defended his faltering invasion of Ukraine at the annual Victory Day celebration. He said the Russian military is defending, quote, what our fathers, grandfathers and great-grandfathers fought for. An advisor to Ukraine's President Zelensky responded on Twitter saying the Russian army is dying, not defending their country, but trying to occupy another. U.S. First Lady Jill Biden made a surprise visit to Ukraine. Biden had been on a trip to Slovakia when she crossed into the western part of Ukraine, where she met with displaced children and the wife of President Volodymyr Zelensky. Biden said the timing of her visit, which coincided with Mother's Day, was important to her. President Biden will give a speech Tuesday on his efforts to fight inflation. Rising prices are threatening the Democrats' already slim chances of holding on to Congress after midterm elections. The president will draw a contrast between his proposals and a plan by Florida Senator Rick Scott to raise taxes and let Social Security and Medicare expire. And 20 U.S. internet providers will offer high-speed connections at essentially no cost to millions of low-income households. It's part of a program funded by the infrastructure law passed last year. AT&T, Comcast and Verizon are amongst the companies taking part. And Bitcoin is falling towards levels last seen in July 2021. The world's largest digital token is trading at around $33,000. It's part of a wider retreat in cryptocurrencies as investors get out of some of those riskier assets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The reality is that when you think about what Russia is doing in Ukraine, it is a key contributor to some of the price increases that we're seeing both in energy and in food. Today, Russian ships are blocking the ability of food to get out of Ukraine. Because of Russia's actions, you've seen energy prices rise because of the geopolitical uncertainty. So what we're trying to do with our sanctions is to end that invasion as quickly as possible.
A very articulate Wally Adeyemo there, U.S. Deputy Secretary of the Treasury, with some close questioning about what do we actually do on sanctions. I learned a lot in that conversation. Right now, we learn a lot about a better tape. I mean, Lisa, flat out from the grimness of 3 hours ago, the tape is better right now.
It is better. We were seeing possibly 3% losses. Now we're seeing just 1.5%. I do wonder, though, given what we saw in the yields and the whipsaw overnight, whether the trajectory is upward for longer-term yields and how that rejiggers risk appetite, Tom.
Right now, we're going to go to what you care about, which is if you're in the equity markets, when do you buy the dip? If you're in the bond markets, when do you buy the dip? Matthew Dizak joins us now, CIO, fixed income strategist from Merrill and Bank of America Private Bank. Wally, Matt, I love your chart where you say we've been here before, 2011, 2014, 2018. Summon the courage to buy the dip this morning in bonds.
This is not shocking, and that's funny. Thanks for mentioning my chart. I tell my kids that's what I do for a living. I draw pictures and I tell stories, and the story here is pretty clear. The Fed's been way behind the curve. You saw that with the Fed Funds 10s and 2s 10s diverging last year, where the Fed Funds 10s went up to 250 and 2s 10s inverted. But we think now is the time to take a pause, reflect, don't overreact. There are many signs in the market. Again, we are not in the business of calling tops, not in the business of point-in-time forecasts. But if you look at the balance of data in the markets, a number of things say that a low to mid 3% 10-year yield might be where we shake out. First, the euro-dollar curve is inverted. It's actually telling you the Fed is likely to cut rates 2 to 3 times starting the middle of next year. Now, the markets can be wrong, but that's a very weird and specific way for the markets to be wrong. Secondly, if you go back to the last 4 rate hike cycles, average from when the Fed funds rate starts hiking to when they stop, the 10-year moves approximately 90 basis points. We started at 220. That would imply sort of a 310 end. So you put those two together in combination with, we've already seen the largest drawdowns in the Treasury market in the history of Bloomberg data back to 1973.
Well,
you'd have to get to 5.5% to make that not at least half the loss.
And Lisa, I don't have it in front of me, but some great work from an academic on the West Coast this weekend looking at the bond drawdown. Are you ready, Lisa?
Yeah.
Back to 1842, and I can tell you that was difficult.
In 1842, from
Yes.
personal experience,
Yes.
Matt. Just aside from the sort of levels that you're looking at right now, how much conviction do you have to say to your clients, look, this is a great time to buy longer-term bonds amid the carnage? How much can you say that this is actually one of the better bets among a sea of carnage?
We don't have conviction to say it's a great time to buy longer dated bonds. So thanks for making sure I want to be clear on this. What we think is, and our CEO, our Chief Investment Office, we went short duration when the 10-year Treasury hit 57 basis points during COVID. We went to about 80% of duration in our portfolios, which was a good move, has worked out well. Now for clients who are in cash and are earning next to nothing, there is a reasonable opportunity to get a lot more yield, little interest rate risk. The short curve from sort of like Fed funds to 2 or 3 years, steepest since 1993. You can get short corporates, around a 2.5-year duration for like a 3.75 yield. You can get like 2.5-year duration munis at like a 2.5% yield. So the opportunity to extend duration somewhat, particularly on the short end, very, very attractive for a lot of clients. And so we're cautioning them not to overreact. Don't panic here as you see this sea of red. Again, that just brings down the current returns, but it improves your future returns. By definition, lower prices are better for future returns. Clients need to keep that in mind.
Are you thinking of the same kind of potential opportunity, maybe, if things do transpire in credit, given the fact that we haven't seen a wholesale repudiation of the debt? In fact, spreads haven't widened as much as many people have thought. Do you believe that this is just the beginning of more to come, or do you think that this is going to be a source of stable returns?
It really depends, and it really depends on what the Fed's going to do, and it is uncertain, which is why we want people to be diversified, want them to have both fixed income and equities, not go one way or the other. If the Fed does react to the incoming data, gets ahead of inflation now, but then moderates later, then generally things would be a good place to be. If they continue to persist to be behind the curve, then they will have no choice to play catch up. The last time they played catch-up has put us in this situation. If we were talking June of last year, the Fed said no rate hikes, maybe one for next year. QT what? Now we're QT. Not 25, but 50. Not 50, but 50 plus 50 plus 50, maybe 75. But you've noticed the curve has started to steepen again. They're still behind the curve. If they get ahead of the curve and start to slow inflation, they'll have to do less later. If they don't, they have to do more later. That'll be more problems. So again, having some overweight credit makes sense. But again, don't go whole hog on any of this.
Matt, thank you so much. Refreshing. Matt Dizak there with Merrill and Bank of America Private Bank. Lisa, it's refreshing to get away from the eco mumbo jumbo. And, it's something we don't talk about enough, Lisa. It's fluent to say we buy the dip in equities. You got to have the courage to buy the dip in bonds, and that's an open debate right now.
And we've heard so many people come out and say it's a good time to add duration. I think of Kathy Jones. I think of PGIM Fixed Income. A lot of people have come out and said, look, there's actual value here. Where are the dip buyers? They're still not there, right? They come in on the margins and then they go away again. So there isn't this conviction that you're going to find a floor when especially you get a yield curve steepening that says maybe people don't think the Fed is being aggressive enough and that perhaps they're being too dovish for the moment that we're in, Tom.
Well, I'm looking at the Bloomberg Total Return Full Faith in Credit non-Abramowicz chart. She's only looking at credit and high yield and the other, excitements that are out there. And I'm sorry, Lisa, it's a drawdown, as they say. It's
been dramatic. At what point do we start to get some sort of plateauing? And not only in absolute nominal yields.
Wow.
But I got to say the real yield is the thing to watch. And I'm not just talking about on 1 p.m. on Fridays. I'm also talking about the idea that we've seen a 1.5 move up in 2 months in real yields. This is actually one of the main drivers behind some of the people who are taking chips off the table when it comes to risk.
Our listeners and our viewers, Lisa, they own nominal, not real, as a typical rule. Full faith and credit, Bloomberg Total Return Index was -8. It's now -13%.
Oh, yeah,
since
it's
the
been
middle
brutal.
summer of 2020.
It's been brutal, and people will look at this, and this is what a lot of people are worried about. They'll see their statements, and then they'll pull more. Is that going to happen?
It is an eventful day, and particularly after the challenges of the European morning, the tape a little bit better. Futures at -60. The VIX out 3 big figures, 33.19. That means you need to stay with us on Bloomberg Radio, Bloomberg Television. Holtz-Eakin, an important conversation on fiscal America and the 12 noon hour. Good morning. This is Bloomberg.